without further ado, again, apologize for missing last class, but we're gonna go ahead and go over some of the boxes. Let's see here. Yeah, 4 hour and 24-hour boxes. And obviously, if you guys saw some channels, we'll put those together as well. So we're gonna go over that today, and then we're gonna finish up the whole concept. While I explain these, we'll talk about it as well before we move on to option contracts, so on and so forth. All right, and we're gonna try and wrap this stuff up relatively soon. So, all right, now, Rogue, 1, 2, 3, good points of contact, punched out, punched through. Yes, that is a punch down into empty space to the floor. And obviously, you got consolidation here. You might argue that that's your floor, though, but otherwise, pretty good, pretty solid chart there. Yeah, I think that actually backs up my claim here, right? Top and bottom right here, and you're trying to punch through actually. Spartan. Let me pull up mine real quick. There we go. All right. So, yep, potential box starting. Yeah. 1, 2, 1, 2. Yep. Looks good. Good job. Yes. Good job. That channel, my brother, could probably go on that wick right there. Tap, tap right there. Probably started from here. So shrink it down a little bit, but otherwise, good job. All right. Labubu. Yeah. There's probably a down channel too, right? This whole thing is inside of a big downtrend. Good on the box. Good on the box. Yep. Good job. You guys are doing a lot better here already. Very good. Blake, nice job. AMD. Yeah, you could call it a box now, especially if it gets up to the top there and breaks. Definitely a box on that one. So good job on that. 4 hour looks good as well. Cool. Now this one I can obviously you're only charting on your phone, so I can only see what you've provided me, but um I would encapsulate that. So the range right here is not descriptive enough for me to see what you're actually doing. That would be correct. Yep, good job here. That was a little box you popped and punched. Looks good. Box has been punched down through. Same thing. That was a little range, but yeah, punch through here. Channel could probably snug up a little bit. And yeah, I'd like to see where that starts from, but otherwise it looks pretty good. Now, I don't cut through price, right? I don't do that. I give it the whole enchilada. So on the channel, good on the bottom, but not on the top. However, this is not a box, right? This is a series of ranges stacked. This is a box, and this is rejections off of cost basis. Okay. All right. So I still think we need a little bit of work on these, right? These are just candles sideways. And I do think that, again, not sure if this is a phone or an iPad, but if it's not, then again, like you've seen from all the other people that have posted here, again, maybe, well, not even really a 4 hour box. These points, these wicks out here, it does form a range, but this looks like pre-market range. So that would be something I would want to see addressed on a lower time frame, which is why it's so small. All right, let's see here. Snug that box down a little bit to the top of that, and then the bottom of the wick body. Same thing here. That's your floor. Good job on the ceiling. Good punch down. Now this one, you could argue that this one has a floor here, right? There are points of contact there, so I've kind of battled with this box. Um, but what I've found here is that the more you zoom in, the less it actually makes sense. So just a tough one to be able to put price on when I think in reality it's actually making a weekly box. However, those points of contact, are clear, across the top and the bottom. So I mean, the skeleton, like you're pointing out, is still there. But let's see. Now, like I said, on that 24-hour, lot clearer. Lower time frame, it gets a little bit messy. Russ, good job. Yep, it's a good box. Yep, good job. Trying to move through these quickly. Yep. Maybe pull that down a little bit to the top, but otherwise that looks great. Same thing. Pull that down to the points of contact on the top. Radar. Yeah, that's got enough. Although that is not a box, and neither is one, two. Yeah, you don't get that third one, so more of a range on that. That, however, I think you just need to pull that one up a little bit further on MasterCard. Let's see. You don't even have solid points of contact. So you build a box around cost basis after filling up that gap, which becomes your resistance. Most of the price gets held down here. So, I mean, it is a box. It is a box. MasterCard is just also a box of a stock to trade. Okay. That's a good channel. That's a good overall channel. Yeah. That looks good. Okay. I would change my channel on the 4 hour. Yeah, you would want it to encapsulate all that price and hug a little bit, but that's a great box. Great dip. Candle close solid after that dip right there, the wick, and then gone. All right. Damn. So I mean, I see what you're seeing for sure. It's just the way you posted it does make it hard to see exactly what it is. It's so damn wide. I'll give you this one because I see the points of contact on the floor and on the bottom and the punch back and push over. But the other chart you sent's a little bit clearer. Yeah, there's that tail, right? Dip down and then push back up. So, all right, let's see here. Blake, again, good points of contact on your channel. That looks good. Yeah, it's a box in the middle of formation. There you go. Oh, excuse me. That looks good. Yep, good points of contact. There you go. There you go. Perfect. Same thing there. Yep. Okay. All right, last one. All right. So Tap tap. I see the candle closes. So yeah, that's definitely a box. You would definitely use it as such. One thing I'm noticing though, well, yeah, I'll leave it like that. Yep, that is the floor you would have to recover, and then punching over the 50% mark would give you the top. So yeah, it looks good. All right, last one. Uh, yeah, that looks all right. The channel looks all right, and then I think I have my meta box a little different. Hmm. Yeah, this one's yeah. There you go. And then candle closes are here. So that's the box right there. And then on the lower, on the 24-hour, so I would at least give it these green candle bottoms. But other than that, looks okay. Yeah, looks good. Top looks good. All right, last one for real. Nope, nope. You can't. This is a bounce down up, right? And then immediately off. This can't be counted because price leaves the area of consolidation, then comes back down. So this is not be cannot be included or called a box. Range maybe, but and it does punch through it and go into empty space, but other than that, no. All right. Meta is difficult. Yeah. Meta is difficult. Oof. A lot of info on this chart, my brother. I can't see what you're showing me on this one. I do see that right there, but you're missing the top of that candle here. All right. So I think the question, obviously, before we move on here is, does everybody feel like they've got a grasp right now, a full understanding, or obviously using this tool that I'm giving you here is you're going to, the more you do it, the easier it becomes, the more you participate in the study room, the easier it becomes. So does anybody still have any questions before we move on boxes in themselves, bottom, ceiling, floors, channels, anything like that before we move on? If you're not perfect at them, right, that's something that you can refine. But as far as the concept is concerned, the waves, the one, two, three, do we get those concepts, class? Why is this not? There we go. Multitasking right now. All right. Now, I guess only one person. All right. Well, as long as, again, I just try to make sure before we move on, those of you who are present, again, understand what we're looking for. We're looking for empty space. We're looking for consolidation, and we need to know how to identify that. Okay. All right. Yeah. Don't be shy. Now, the concept, right? We've gone over this several times now. About what a punchback is, right? What we're looking for on a punchback. A punchback is price moving through the 50% mark of a box. This is not a great box, but 15 or 50% mark of any box on any time frame is in fact what we're looking for. So I get the Potter box, but all this stuff kills me. Not perfect, but I got it. Yeah, that's what we, again, I don't expect for you guys to, the first time that I'm explaining this, for you to be masters, but you should understand what we're looking for, right? There's two things: empty space and consolidation, and waves, typically 2 to 3 off of both sides. Obviously, a break of that structure is typically where we look for our entries. So, all right. One thing here. The more that you watch me, the more that you trade with us, the more that you do your own charting on your own time, the better you're going to get. Period. So, to use a classic example, and again, if you have any questions on this, because I feel like this is something we've already gone over now fully in depth, but I'm going to pop spot a few of these and again walk you guys through this. But a punchback, which again we've already covered in depth, but just to make sure that we're going over this. Now that you have your boxes, floors, ceilings, when price loses its floor, its box is lost, and this is to the upside. Typically, we start to see sellers squirm when price on that floor is being recovered. And when cost basis is broken, that's when I have my eyes on what's beyond it, right? The first target here would be right up at that green candle, and that's in fact where you go. On a punchback, is there a box built below our box setting up the punchback could be that. Hold on a punchback, if there's a box built below our box setting up the punchback, could we be early on the entry? You're good. You're good. The problem is that I run into on the punchback, and the candle moves quickly and either makes a new high or low, is when to expect continuation. You should be expecting continuation when the 50% mark is closed above, or, granted, you get to take it intraday. Um, and again, there's many ways to be able to spot when something like that's going to occur, right? And that's usually by dropping down and looking at this lower time frame, right? Where you can kind of, like in this example, we have a gap, right? So we expect the price to fill the gap. At that point, price returns back to the floor, bounces back up. So even on that, right, this small range getting broken, or the new high over here, you could be looking at a potential entry. Do I remember when I entered that Mara trade? That's not the Mara trade that I entered. The Mara trade that I entered is way back here, somewhere in here. I'm not exactly sure. Hold on. There it is. This is the Mara trade. We entered this the day after it closed on this floor. So we were actually looking at Mara punching back after it closed on the floor. I hadn't grabbed anything at that point. Um, yep. So we grabbed this one as it broke on a lower time frame above the top of the box. It doesn't have to be perfect. No. You want, like, if you really were like getting in on this, like, like maybe the wick is just like a fraction off. Like, that's the type of discrepancy you can ignore, right? It's the points of contact all across the board, right? That show that, okay, that price is what they want to hold, right? Or that price is where we don't want to recover. Do you use TradeStation on TradingView or separate? No, I don't use TradeStation on TradingView. Yeah, you don't have to have it perfect. And the same concept is obviously used to the downside, right? So it's the same both ways. And it's the same. I use this to day trade, I use this to scalp. We've been using this obviously on lower time frames lately here, with price moving the way that it is. But, going back to, again, I've used this example several times, but it's just useful for this scenario, right? Where we build structure like this. And in the same way, right, if I was to flip this chart upside down, price gets stuck underneath the top of that box. That's typically where we'll look for A, and in this case, you ended up gapping down underneath that floor or to a new floor underneath that box before popping up. Um, yeah, that's not a priority buster, for me anyway. So when we're looking, and one thing I want to say before I move on, um, my system, right? Where or even just the part of the system where I focus on shorter expiration contracts only happens in areas that are clear, empty space. That is the most lucrative areas to be trading these shorter expiration contracts. Um, but for something like, a 24-hour floor or even what we're dealing with now, and I have to address this because I'm having even a lot of people who are like, I'm struggling, right? Like with this, and then they'll tell me what they're trading, and it's like, they're trading something that isn't. And I just want to make sure that everybody's clear on this. That I use the Potter box to invest, right? Buy shares. I use it to buy longer term swings. Um, I use it to swing trade. But anything that I'm doing on the cues right now would not be adherent to the box and the higher time frame trades that we use, right? And the only way that it is when I'm down on lower time frames. What does that mean? And if you didn't see, right, what that means even today, where price moves really, really quickly, back up, back down, back up, right? And it was within like the first hour that there was already multiple, trades that could have been taken on both sides. So is the Potter box everywhere? Yeah, all the time, always. But as far as making these big strides forward and capitalizing or maximizing your investment, this is done on setups that are clear. And that isn't, and I discussed this at the beginning of the class, there's pro traders who don't show up every day. They don't show up every week. They sometimes don't even show up at all for a month if their setup is not there. And I'm not saying that has to be you, but obviously if, champions are waiting specifically for their setup, that's when they're able to take big leaps forward. So I just anything whenever you're taking a look at a stock or you're planning a trade, you need to be real with yourself about where price or what you're looking at and if it is my strategy on the higher time frame. Because the anomaly, right, is that I found is part of market structure. It's how the market moves. But when you start to zoom out into things, right, like this, are we in a box? For sure, right? Do we have multiple waves off of both sides? Absolutely. But do we have a break of this structure? No, right? So it's just again when we're looking like people who are trading right in this range are having a difficult time. I've had a difficult time. Shit, I got my feelings hurt yesterday, even though it was just a gamble. I was so certain, right? Everything that I built, oh, I just typed it in again, right? Was yeah. I mean, we've gotten some good trades off, but it's like as soon as I make a bag on this thing, I'm not using big risk on that next trade. Um, but it has been, and that is how price moves inside of a box. It is so hard to trade. And I've seen a lot of people getting beat up with it. But, I was short right here. And we actually took $600 puts. It was like right around 610. Price was retracing back down. And they almost gave it to me. They gave me 605 and they gave me a gap fill. And I was at this point, again, am I, can't say that I'm using the box, but I am looking for empty space and a break of structure. But the reality is when you're inside of range, right, like this, it is just flat out, period, point blank, not always going to move on your time. If you are trading in these ranges looking for a break, your expiration must be great in order to deal, or even if you're looking to short a floor, your expiration must be great because floors do what they're intended to do, as you can tell, and they bounce. So before again we move on to everything else, um, make sure that that's what you're seeing, okay? Because I'm about to get to the point where I stop taking requests on TikTok and just take requests on. I know that probably kill my stream, but um, it could it not probably not. But I mean, I just get to the point where it's like some people will show me a setup and there is no Potter box. There is, not to if you're in here, I think somebody showed me one earlier. It was like a weird biopharmaceutical stock, and it's like that thing had pumped and dumped and it's all over the place. I can't help you with that. I can't. There's literally nothing I don't have, and that's why I try to be honest about it. It's like maybe there is a strategy that works for that, and I'm sure there is, but I don't have one, and I've never built one to trade into all-time highs or to trade something that doesn't provide me clarity. And there's too many stocks that do for me to get stuck on one. So no, it wasn't Zebo. It wasn't. No, that was somebody else. I mean, I get a lot of requests, for different stocks, and again, it's like, of course, yeah, I know they are mailman. Yeah, a lot of people on there are fishing for me to just tell them to buy or sell. So my stream is stuck on Mara. Alex, are you watching my stream? Oh no, he's recording. I'm looking at the cues right now. Yeah, that's right. You're not resharing. Okay. No, it's not him because he's just recording. Yeah. I mean, even what I'm doing right now on Tesla, I took Tesla short. It is adherent to the concepts that I use. And when I can see those concepts, I have time in the market and I can try to use those. But, this is actually close to what I want to see with a price moving outside of the box and then getting pulled back in. So definitely, has the empty space that I'm looking for, all that other good stuff, but it's still not a punchback or a 24-hour punchback. So Tesla's I put about 6 grand into that trade, man. So, it's not my stream, it shouldn't be. Alright. Can you see that? If it's good all the way in the Philippines, it's gotta be good. They don't want me learning this. Maybe. That shouldn't be my Wi-Fi is still good. Or I don't have Wi-Fi, I'm ether wired in with fiber. I can reset this stream, hold on. There we go. Okay. Better? Alright. Wow. Alright. So really quickly, and again, this is basic for a lot of you guys, probably basic knowledge, but we're going to talk about the options chain. Again, we are still teaching new people here. So if you already have it, take a drink of water. All right. So, one of the more important aspects to picking a play is obviously being able to navigate and choose what you want out of the options chain, right? Knowing how to correlate the target, but obviously just using the chain itself is also important. So if you open your brokerages or you are looking at your brokerages, for a lot of you guys who are new, we're going to cover what these numbers and stuff mean so you know as well. All right. Now, we're going to start obviously dead slap center. And when you're looking at the options chain on your phone, on your computer, it's typically going to be right down the middle, right? And if you have it any other way, then you probably have it so that it's only put side or call side. But otherwise, these are going to be the prices that you're selecting. Typically on the right side, looking down, right? If it's shaded, it's in the money. If it's not, then it's still outside of the money. And those are, again, typically the contracts that we're picking. IV, right, reflects the market's expectation for how volatile or how much movement a stock will be or how much stock a stock will have in the future, right? So it's predicting volatility in a way, and they do use it as such. Now, is that accurate? Not always, but it is typically increased by volatility in the market. So big whip up, big whip down, right? Or big event coming, QQQ, CPI, all that other shit. That's typically how or where we'll see those contracts inflate. If you see a big move in any direction on the ETFs, you'll notice a massive increase in price. Yep, Trump tweet, any of it, right? And those type of things will temporarily inflate them, but a big event like CPI, that'll have it inflating days before. Volume on the options chain refers to the number of option contracts that have been traded for a specific strike price and expiration on a given day. Literally tells you how many times that the back and forth has been happening on that particular contract. So if you look at something like Tesla, right, you'll see typically a lot. Not always, but sometimes, most of the time. Your big tech is going to have regularly trading contracts. Lower volume typically can lead to lower spreads or wider spreads, excuse me, which the spread is the bid and the ask. We're going to go over that in just a minute. All right. Now, speaking of, right, the bid is the highest price someone is willing to pay for an option, right? The ask is the lowest price that someone's willing to sell it. And obviously, the broker is making money in between the bid and the ask. There's a little war there. So here we have a $10 spread, 350 bid, 360 ask, which is why we typically try to limit a lot of the times so that we can fill somewhere in the middle. All right, now open interest, right, is the number of contracts that have been before I move on. If something is ripping to your target, you want to hit the ask. It's ripping to your target. You want to hit the ask, or sometimes you can even raise it 5-10 cents or 5-10 points. And then if something is pulling away, right, from your target, you're typically going to have to sell at the bid. If price is fluctuating at your target, kind of popping up and fading back and popping up, the limit is going to be a focus. So as you're going to your target ask, you can even sometimes, and I know I don't do this very often because I don't have time. But some people even go and look at the option contract chart, which you can actually look at the chart of that option contract, and they'll pick a price to sell it at, right? Correlating to the chart, because you can see the same things you see on an options chart. You must be careful with that because you're not always going to go right back up to the same price that you were when you hit that target before. So it's important to be careful with that. All right. Uh, I'm not showing that right now, but if you click on the actual, it depends on what brokerage you have. Not every brokerage does that. So, open interest is the number of contracts that have been created and are still active yet haven't been closed out, exercised, or allowed to expire. So you can see, right outside of the money, you got 13,829 on the open interest, pretty heavy. All right. Now, this is right your typical setup for most traders, right? Obviously, there's some like we will swing shorter expiration contracts into empty space. That is something we do on a relatively regular basis. But for the majority of folks, right, scalpers are going to be using shorter expiration contracts, typically those that expire that week or that week or that day or uh, the following week. Typically, it's the more volatile contracts they're looking to get a hold of. Day traders, they do use those shorter expiration contracts, but in order to deal with the intraday volatility and the up and down, a lot of the times we'll be focused on a little bit longer. A lot of you guys need to be focused on longer expiration contracts and need to let go of those ODTEs because you don't get stop losses on ODTEs, right? You're red if it comes back to where you got it from. So you have to have trail stops and know how to do that or know how to set. Once something breaks the resistance, you're using that resistance as a way to get out of the trade rather than the where you got it. All right. So anything obviously 3 to 4 weeks away, a week away, 2 weeks away, day traders, short swing traders. Uh, and then we have, things that are typically like a month or even um, a month and a week away. And those would be, again, 5 to 7 day swings, things that you expect to, run for 3 or 4 days and you're getting out of. Now, TTI has spoken in some of the previous, and he's a partner of mine. If you don't know who he is, he owns the Trading Initiative. As you know, I am not a big fan of most people on the internet. However, he's one of the exceptions, as he is great at what he does. But they are obviously for people. They focus more on trades for people who just cannot be at their desk all the time. And this is something you can use with my system. Most of the people, a lot of the people who are in his group will be in my group, or vice versa. And they've, he trades stuff in breakouts, right? A higher time frame, sector rotations, into, I think they were like in railroads, they were in gold, so like they do it, but they buy really, really long expirations, 80 to sometimes even a whole year away. Um, and this does, again, is something that you can utilize with my system. Yeah, I was just gonna leaps is what they'll refer to, or again, long swing trades, damn near, going on 3 to 4 months have to be called something else. So but anyway, those are how, or rather where people focus on these contracts depending on what exactly they're looking to accomplish. How much do you weigh those metrics into your decisions? um that's a great question. So typically when I'm looking at the options chain, I know that a couple of things are correlated, right? High volume and high open interest typically mean, and high IV typically mean a more expensive contract and more inflated contract, which will lose its inflation if people don't buy it or if price of the underlying asset isn't moving. So I try to take it upon myself to look for things that aren't inflated, coming out of boxes. Those are the ones that people haven't caught wind of yet. And I usually, that's how a lot of the times when we're trading IWM, right? Nobody's thinking that that's a real target. And therefore those contracts carry really low value, and there's not a lot of hands on them. But it's only until that price becomes an actuality that they swell with IV and volume, and that's how, again, we like to stick to target based contracts. So when we find a target on the chart, right, box to box through empty space, is or right, if you're swing trading or looking at leaps, you're seeing a series of empty space, right? A box, maybe $10 ahead of you, um, but beyond that, right, something like elf, right? And the only problem with elf is the contracts on it just are terrible. But in the future, you can get people do trade them. I mean, they're not the worst, but they're really pretty bad. Um, but fast forward, a couple of months, years, who knows, and Elf comes back up, right? It's these pockets of empty space, right, that are a part, right, of the structure that we need to recover. If Elf cat just flushes down and goes to 56, this would be great, right? But you want to see that there's future room, right, beyond what you have to break. So if we have to go, and again, we move down here, it would be areas or floors like that one, right, that would need to be reclaimed, and this one. But you could be looking to grab a leap, right? Maybe if you build a box here and it breaks out of the box like it did there. And that's what you could have done. I bought equity, but that's what we essentially did on this. So have I ever back tested? Um yeah, I mean, yes, yeah, of course. When I was building this system, I wasn't really back testing in the same way that other people are. Because one thing that has always been apparent to me is that discretion is needed in the moment, not in hindsight. And so there's a lot of different probabilities that can happen on a setup, like, and if it's just for brain training to, if you haven't looked at it. But I haven't like back tested it to like trade it. I back tested it while I was building it to see if what I was seeing was real, because I couldn't believe that I had trouble really comprehending that nobody had figured that out. That nobody had put these things that, you do have concepts that are close, but not together. They're all separate. And it just kind of was like, well, nobody's put this shit together, like all together. Um, did Alta dump? Huh. uh, well. I bought two contracts. But anyway, to finish that question up, man, it, it's something that I don't do that anymore. You know what I mean? When I first started this class, I thought it was order blocks, and it's really not. It's pinpoint accurate places of price action consolidate. It does take it does. So, I'm not a huge fan of this kid, but he is smart, and he did mention, and in one of his videos, you probably seen him, his name's Thomas, but his dad's like owns hedge fund or something like that. So he was like born into it. So he's a little presumptuous. Um, but eh, when you back test, right, you're back testing price action that's already occurred. And if that same setup, right, was to occur, not same setup, but if price was set, and this is, again, especially with other strategies that, aren't as efficient, those yeah, they're good quants. But those individuals, right, can look at that back testing program and see that it doesn't line up with the probabilities that are to happen in the future. Like, there's no way to guarantee that price is going to interact the same way that it did. Um, like if you're looking at long-term trend. So I don't back test trading. Like I back tested my concept. Does this concept work when this happens, right? When you punch through this box, do you go make a new high? You do. But how, right, we navigate that box is going to be different every time. Discretion, right? Problem solving. That's why it's needed. And so it's better to focus on what's in front of you, right? Rather than trying to and not to say that, yeah, again, I'm not somebody who does or did a lot of back testing in the same manner that other people do. But I mean, you could try it for yourself to make sure or prove or show that the concept on a higher time frame, or lower time frame does work. So he's smug and arrogant. Yeah. He hasn't said anything to me though. He we had a one little tat where I said that options were literally leverage, and he was arguing that they're not. But whatever. All right. Well, that dump on Alta was kind of straightforward. I think that one might climb down a little further tomorrow. Okay. So anyway, to finish that up, feel free to try it yourself. On a lower time frame, maybe that would be pretty helpful. Um, but yeah, I don't do that in the same way that other people do. So, all right. So we're gonna break these different aspects of the option contracts down really quickly. So again, IV, some of this is going to be repetitive, but expected volatility, IV reflects the market's expectation of how volatile or how much movement a stock will have in the future. If IV is high, the market thinks the stock could have substantial price swings. If it's low, minimal price movement is expected. Yeah, I mean, I'd be interested to see your results. Yeah, but I don't back test. I The way he back tests them is a lot. Thomas, the quant, he runs them through a coded program, like, which is a little different than the way that other people online back test. So, all right. Pricing of options, right? IV directly impacts the pricing of options. Higher IV generally means higher option premiums because there's a greater chance that the option will finish in the money. Conversely, when a IV drops, options usually become cheaper. Now, non-directional movement, right, is essential to understand that IV does not indicate the direction of the expected move. High IV just means that a significant move is expected, either up or down, right? Now, with that being said, I like when stocks or options have disintegrated, right? Or they've lost that IV and they've gone into consolidation because it's if you can, and sometimes this is where I'll speculate is when price gets really, really bunched up and that IV dies off, any move rapidly will increase the IV of those contracts rapidly. Oh, that's sick. Volume. Volume on an option contract refers to the number of option contracts that have been traded for a specific strike price and expiration date on a given day. In simpler terms, it's a tally of how many times that particular option has changed hands. Why is this important? Liquidity. Higher volume options generally mean that there is a lot more interest in that particular option, which often translates to better liquidity. Better liquidity can mean narrower bid ask spreads, making it easier to exit and enter or enter and exit positions without a significant price impact. Indicator of activity. A sudden spike in volume can sometimes indicate that traders have new information or renewed interest in an underlying stock or market sentiment. IWM in a punch down, got in when the price crossed cost basis, quick scalp for 92%. Potter box or nothing. Yeah, there we go. Yeah, we did start early. I was starting early because I felt bad about missing class. I don't like doing that at all, but I'm also, maybe a little helicopter parent, worried about my kids. Open interest. Open interest represents the total number of outstanding option contracts for a particular strike price or expiration date. In simpler terms, it's the number of option contracts that have been created and are still active, yet haven't been closed out, exercised, or allowed to expire. Creation and elimination. Option interest increases when buyer and sellers create a new option contract, both parties entering new position. It decreases when existing contract holders, either the original buyer or seller, closes their position. Another party takes the opposite action to close theirs. Different from volume, while open interest and volume indicate trading activity, they're not the same. Volume counts the total number of contracts traded in a specific time frame, regardless of whether they're opening or closing positions. In contrast, open interest gives a cumulative tally of active contracts, but is a snapshot of activity. Open interest, provides a snapshot of how much interest or activity exists for a specific option contract. High open interest indicates many active contracts, suggesting there is substantial interest in that particular option. Apparently, I did that one twice. All right, now bid and ask, right? And this is where, not gonna lie, that 1500% win IWM was a huge win. I never thought it would be possible. Someday I'll explain this more, but that day was awesome. There's going to be more days like it. There's going to be more days like it. They're not every day, but it's those days that we want to jump in and hit it hard. All right. So the bid, right? The bid is the price. The bid price is the highest price that a buyer is willing to pay for an option. Think about it on eBay, right? Price of something is 200, nobody's buying it, or it's just sitting there. So you bid 190, right? But it's at 200, and that's the ask. So it's obviously somewhere in the middle that somebody would have a higher chance of getting filled or buying that. So they probably again hit 195, the seller would be more likely to give in. But the bid is literally the lowest price that someone or a buyer is willing to buy that contract at. It represents the demand side of the market. The ask, sometimes often called the offer, the ask price is the lowest price at which a seller is willing to sell an option. So it's literally, you have an option, it's valuable. You bought it at $40, it's worth 400, right? So you set an ask or set a sell of $400, and obviously, um, if the ask or the bid is at 395, right? That's pretty tight spread there. That's where if price even pops up a little bit, you're going to get filled instantly. But oftentimes hitting the ask in a area where price is being fought over can be difficult, and you'll have to settle for the limit. The limit is literally bidding dead slap center in between those two prices. That's why it's easier to get filled when you do, or people will recommend that you limit fill, because it is between the bid and the ask. I try to be strategic with it. If price is moving in the direction that I want, I start hitting the ask as I trim. That is how I trim or scale out of a trade, as I hit the ask when I see something breaking or something popping or grabbing a hold of something and pushing. I'll start hitting the ask and selling my contracts for the higher price. The spread is the difference between the bid and the ask price, right? So from 400 to 395, that's a $5 spread. If it was a 350 contract and a $400 ask, that's a $50 spread. Typically, anything over 15 to $20, and I'm looking the other way. There are some tolerable ones. I think Shopify is a notoriously widespread. I think maybe Lily, I think, had a decent little spread on it. Some of them, like I said, are tolerable. And if the move is just absolutely immaculate, in fact, we discovered one the other day, and I think it did exactly what we talked about it doing this morning. Um, but the contracts were trash, and the spread was like $150. It was nuts. So that's something that I cannot do, because that spread, listen, unless uh, a bunch of volume comes and helps tighten that spread up, you're going to have a hard time trying to sell it, and you're going to have to settle for the bid. And sometimes that could be $100 to $200 less. Trade execution. When you want to buy an option, you can place a market order, which fills it at the current asked price. Conversely, if you want to sell, a market order will sell it at the bid price. Oh, your internet is jumping. The spread is just the price between the bid and the ask. So if a bid is at 15 and then the ask is at 10, You have a $5 spread. Is there any correlation between wonky spreads and them paying well? Two examples come to mind, Lilly and Alta today. Um, it's just an example of a lack of liquidity, man. Yeah, it's literally. I mean, not a lot of people are trading Alta. You know what I mean? It's not like it's not Tesla. It's not some of these cream of the crop. Sorry, I'm grabbing a drink. Oh, I love having a mini fridge in here. Um, but yeah, it's not the cream of the crop, right? So it's tougher to sell to an audience of less people, right? Fast, yeah, fat. That I think that was one of the ones. I cannot tell you, folks, how many times. And listen, I can tell you right now that I have bought oh my god, guys, I have some horror stories with wide spreads. I've been filled and down 50% immediately because of the spread. I've had my target get hit and couldn't sell. No matter what the limit was, it was even on the bid, I couldn't seem to get rid of it. What amount of spread will make you 15? It's obviously if you have a $25 option price, you know what I mean? And then you have a $10 spread, like that's too much. So, but typically somewhere around on a contract that's like $100, $200 or something like that, 20 or $30 spread is where I got to back away from that one. So it is based on, again, the stock itself. I pure and simple, I focus on stocks that have good trading volume. Period. End of story. I don't go after a lot of stocks that have wider spreads or have less volume because the spread is naturally going to be wider. So, all right. Now, this is an important aspect of this because I get this question a lot, and there's different ways. There's so many different ways that people can play this strategy, right? I'm giving you essentially the blueprint, right? And you can build whatever you want off of it. So you could be trading, again, longer expiration only. I have a lot of students who have settled down from their gambling ways and have chosen to only take higher time frame setups um, with longer expirations, right? Yeah, widespread's no good. So in the money and out of the money, right? So we're going to talk about both of these and why they matter or why it matters. So in the money, pros and cons. Pros, there's a lot of the times a higher delta right at that in the money contract. In the money contracts have a higher delta, closer to 1 for calls and -1 for puts, meaning they will move more closely with the underlying asset, right? One tick up, you're going to feel it. You're going to see it. A higher delta means that the option price will change more significantly with a smaller change in the underlying stock price. And we're going to talk about the Greeks here in just a moment. Literally. i- the intrinsic value, right? Since they are in the money, options have intrinsic value, which means they aren't just made up of time value and implied volatility, right? They can actually be used. This reduces the rate of time decay relative to the option's overall value. Now, what's bad is if you have an in the money contract and it becomes an out of the money contract where you lost your intrinsic value and it's been replaced with IV and volume, right? Or time value, excuse me. This reduces the rate of time decay relative to the option's overall value. Lower theta, right? So the rate of decay is going to be lower for contracts that aren't just time, because theta is tracking the rate of decay over time. While all options experience time decay. The actual dollar amount of time decay is typically higher for at the money contracts or out of the money contracts when compared to the overall option price. In the money options have more intrinsic value, so the time decay is smaller portion of the option's price. It also has a higher probability of retaining its value, right? Have you ever bought a contract with me? Have I ever assigned somebody? Uh, no. I don't I don't think so. No. I yeah. Um, Higher probability of retaining value. So IWM or IWM, look at me, I'm scarred. In the money options have higher likelihood of finishing in the money at expiration, making them less speculative compared to at the money or out of the money contracts, right? And those of you guys who actually this just happened to me, right? I was in $600 puts. We got one spike down. The contracts were worth 90, $80, $100 a piece, and then one candle, right, takes that away immediately, and they're back down to $21.15, and then because we didn't move for the rest of the day, complete decay. That's why when we're handling ODTEs or contracts that expire that week, we want them to be in an area that lacks resistance so that way you can trim them, because when you're trading on these lower time frames, it is in and out, it is scalping, and that's when we're locked in a box or even not opening outside of a range, we don't get fluidity, and that's what we want to take advantage of when the opportunity arises, is when the stocks are moving fluidly through areas that lack resistance. That's the areas that we want to highlight and capitalize on those. All right, now here's some of the cons. Now they're going to cost a lot more money, and I know everybody in here probably knows that. In the money options are more expensive than at the money or out of the money options because they have intrinsic value. I can use them, I can assign them, I can exercise them, right? This means a greater initial investment is required, which means more capital is at risk, right? Lower ROI. While on the money options might move more in dollar terms, the percentage return on investment is often lower than out of the money options because of the higher initial premium paid. Lower gamma, right? And the money options have a lower gamma compared to at the money options. I'm going to teach you what gamma is in a minute. This means that the underlying price moves, the rate of change or delta doesn't change or is not as rapid. While this can be seen as stability feature, it also means the option doesn't get the acceleration benefit that at the money or out of the money option get as they move into the money. Liquidity concerns, sometimes especially for stocks that aren't widely traded, in the money options could be less liquid than at the money or out of the money options, right? Because think about it, a lot of the option market is just traders. They're buying and selling these contracts, not utilizing them. A lot of institutions do that. Um, So when we have a stock that, you're trading MasterCard or some shit like that, and your contract goes $10 deep in the money, you can actually have a hard time getting rid of that contract. So if I get a sign while I'm in the money, but I don't have the amount in my account, what happens? Uh, you're cooked. No. Typically, well, let me just say this first. This never happened to me. All right. So I I take that back. It did happen to me on Plug. It happened to me on Plug shares. That's the only time I've ever been assigned. I thankfully did have the money to cover it, but if I'm not I mean, honestly, this is probably something I know this is not professor material, but I straight up just Google it. What happens if I get assigned while I'm in the money with option contracts, but I don't have the amount to buy the shares in my account? I'm just gonna Google it. I have no idea. If you're assigned on the in the money option, short pull put or call without sufficient funds, your broker will create a margin call. That's what I thought. Likely using your buying power to force liquidation of the position to cover the deficit. This can result in significant financial losses as you may be forced to buy in shares at an unfavorable price. Negative, yeah, your account's negative. So what I'd recommend is just shutting the account down, moving to a different country, and leave it at that. No, just kidding. Yeah, they sell everything you got. They liquidate whatever they have, and then they will, yeah, basically bill you. Yeah, get out of town. All right, now out of the money. Obviously, this is my time to move to the Philippines. Yeah, I've been having Ivy and Alex put me aside a little room in the closet just in case. It's my tax haven. Isn't that right, Alex? Um, so for out of the money contracts, which obviously is a lot of what I do, right? I'm playing out of the money and I'm playing option or target based contracts. Oh yeah, that'd be nuts. Um, Lower premium. Obviously, this is one of the things that attracts me to the out of the money contracts is and again, it has to be my setup. People get really lost in the ODT sauce. They get lost in the weekly sauce and they don't know how to fluidly move. Okay, this is a longer expiration trade. Why? Because we have, right? Why didn't I take Tesla weeklies off of this rejection? Because I have a floor beneath me. Because I have two nasty wicks that will bend me over and whip my ass if I choose to try to capture all of this without that. So in order for me to be prepared, right, I gotta have I can be out of the money, but I need to have time. I didn't know I was on a margin account, $4,000. They still sold one of mine. I switched to cash. Right, I didn't know they. Oh yeah, yep. So lower premium, right? Out of the money options are generally cheaper than in the money, right, or at the money options because they have no intrinsic value, only extrinsic time value, right? So the probability that they could be useful is what we're trading. Literally, it's literally the speculation on whether we can use that contract before expiration. So intrinsic means we can use it. Extrinsic means you can't, but you could, but we don't know that yet. Higher potential risk or return on investment due to the lower initial cost. If the underlying asset has a favorable move, a percentage return on the out of the money contract can be significant. This high leverage can amplify returns. Limited risk. The most you can lose when buying out of the money options is the premium you paid. People who are over risking their accounts and putting way too much into weeklies when they should be buying two or three contracts at a time at most. Yeah, I'm talking to you. But the most you can lose is the premium you paid. This makes it possible to speculate on certain stocks or market movements without risking much capital. Like yesterday, when I had people DMing me, what are you going to do with the $600 puts? Dude, I could have jumped through my window and I live on a one-story building, but just to feel it, just to see what it feel like. Because I listen, that it's one of the reasons that signals I've found I'll signal something and it'll be straightforward fire. And I'll get maybe the top 20%, they're gonna come out with the W. 30 to 40%, they're gonna have chased and then they're gonna have gotten out early. And the other percent just fucking wrecked it. They got in late, got out too early, never didn't make anything, so they got back in. You know what I mean? It at some point, right, we got to know when to call it quits, but we also need to know how much money we should be putting into these things. And a lot of you folks who are trying to grow your account, guess what? I have built a strategy that highlights when these big moves happen. And if you want to play weeklies, you got to focus on those. I will be doing bad things sometimes because I can afford it. But I also have a limit, and if I hit that limit, which I did, I took a fucking excuse me, I took a $1,600 loss because of that. Now I made money elsewhere, so I ended up being up like $300 that day. But That that was my gambling amount, partially. And I went into it, had an idea, which I was right, but the wrong time. And of course, people were holding on to that as if that was a share or something. So again, if you are getting into, and I'm just touching on this because a lot of you can't afford to be doing this. A lot of you can't afford to be trying to trade on these lower time frames. It's the bigger moves that are just like the higher time frames, guys. It's just slower. It's just slower. And it's those areas and those stocks, compiling a list of stocks. Neo just did it. You didn't have to risk a lot on that one. Potter's been doing it for years and we barely started. I mean, I know it's not my fault, but I know the audience who's watching. You know what I mean? And I know that the goal is money. And so my message is going to be interpreted differently. Yeah, Rivian, right? And there's different like places, but like listen, with the ETFs, I've actually noticed this. Watch this, right? 1 2, right? Now this is an inside day, so I'm not counting that. 1 2, 1 2. Chop them. One down, chop them. Right? And then they keep that chop going. This happens at the beginning of all ranges, big up, big down, right? And that increases the volatility, makes you think that tomorrow you can do the same thing. But we are hitting these quick moves. Now, when the cues start breaking down and if we trend down, right? You could say this is different for a bull market because obviously the opportunities can be there, potentially every other day or, coming out of a range, they could be there. But in these tight consolidation areas, off limits. And so one of the biggest things that you can do before the market opens is ask yourself, are we in range? Yes, right? Yes. So no. It's when we leave ranges that we get bigger moves and you can play with those out of the money contracts. All right. Now, those of you guys who have time under your belt, right? And I know that some of you guys are in here and you scalp or you day trade and you got it down. Like obviously do your thing. But I still do my thing with light risk. So when I'm in range. All right, now moving on. So, limited risk, you can only lose what you put into it. And if you only put what you are willing to lose into something that's speculative, right? Obviously, that's a good thing. Now, with a longer expiration, right, you have a lot of time value. So, it's actually good. It's good for you and allows you to hold through certain things that otherwise, with shorter expiration contracts, you wouldn't be able to. Yeah, I know that's why you're careful with what you say. That's exactly why I'm careful with what I say. That's why I didn't tell people I was getting into Alta. I couldn't do it, dude. I almost said it twice. I only bought 2 contracts. But guess how much that is? A lot. Yeah, some people know because I get quiet. I get real quiet. So cons, higher probability of expiring worthless, which I know some of you guys have had your contracts die in your hands, last breath and all. Out of the money options have a higher risk of expiring worthless compared to in the money and out of the money or at the money contracts. If the underlying asset doesn't move past the strike price, the option will expire worthless. It's just important to remember when you are trading these weeklies, because if you're buying it and it expires that day, just imagine at the end of the day, it's either going to be worth something or it'll be worth nothing at all. Higher gamma, which is why we don't hold those contracts longer than typically 20 to 30 minutes, if that. And if it's towards the end of the day, sheesh, be careful. Higher gamma. And real quick, there's going to be, every once in a while, you'll get an end of the day dump on a Friday or an end of the day. Like, I mean, literally, Friday end of the day dumps are kind of rare. But when they do happen, the next 2 weeks, 3 weeks, I just watch people drop like flies because it makes them think that it's permanent. It's going to happen immediately again. It's like, no, if you've moved here's a good blueprint to write down. If you've moved all week and you've had a volatile Monday, Tuesday, Wednesday, expect a choppy Thursday, Friday. If you've not moved all or if you've moved all week, then expect a choppy end of the week. If you have not moved all week, then perhaps you can look at a potential break towards Wednesday, Thursday, Friday. Typically, I like it when Wednesday or Thursday you start to see the sign that that break is going to happen, and then I feel better about it. But remember, it's all based on the chart. So, all right. Faster time decay. Now, you probably, like I just said, with the Qs, I was up 160%, and then in 2 candles, I was down 19%. While all options are subject to time decay, out of the money options can lose value at an accelerated rate as expiration approaches, especially if the option remains out of the money. So if you tease going in the money and then drop away really quick, ooh, one of the worst. And here's the funny thing is like I'm notorious for selling people contract. I say people. I don't know who buys these things, but like I'll buy and sell a contract, early or the night before, and they'll be worth 20, 30 cents. Price will explode, right? The next day, and I'm up two, three, four. I mean, kind of like Tesla did. I'm up 600%, and I'm selling this contract, and then coming back later on, that contract I had actually I had 415s on Tesla as 414 was my target, and it went to 416. And I sold these contracts at a hefty premium, and then it came right back down. And I looked at those contracts towards the end of the day, 30 cents. I mean, just awful. Just awful. But obviously being on the seeing that move and being able to play it is an important part of this, and then knowing when to get out. Because I tell you what, when it comes to my levels, I know my levels slap. Is that the cues really? Okay. Hold on a second. Oh, I thought I saw a different price. Um, let's see. All right. Now, lower delta. Out of the money options have a lower delta, closer to zero, but we're going to talk about that, which means that they will move less for every dollar movement in the underlying asset compared to in the money option. If the underlying doesn't make a significant move, the option price may not appreciate much. So, what did I just hear? I just heard, in other words, if you know that that price can't go far, what are you doing? Right? You want a significant price reversal, breakout, breakdown, punch back, something. You want to know that there's not a lot in front of you. That's when those shorter expirations can be a low risk, high probability return investment. That's when. Um, and so if you see something that's not a significant move, then you shouldn't expect for it not to give you the return that you were looking for. All right. Liquidity concerns, especially for widely traded stocks, out of the money options can sometimes be less liquid than at the money or in the money options. This can result in a wider bid ask spread, making it more challenging and potentially costly to, potentially costly to enter and exit trades. Potential for greater volatility. Out of the money options can be more sensitive to changes in implied volatility. If implied volatility drops, the option price may decrease even if the underlying stock price remains unchanged. Do you ever trade in the money? It's been about a year and a half since I traded in, no, 2 years since I traded in the money. So, no, not really. Um, Typically, the reason why I would trade in the money, Shane, is because as soon as you step outside of at the money contracts, the spread is disgusting. Um, but I'm gonna be honest with you. In the money, in the money contracts on things that have, and I think that's the lesson that I learned from it. It was like, the return really wasn't worth it. Yeah, but at some point, right, your delta is good, maybe in comparison to your contract. Because I have an example that I've given before where like I saw meta contracts at like $700 and a delta of 39. And it's like to invest that, and then yeah, you need like a fucking $10 move, to happen for you to like see, a decent return on that without having to risk a lot. So for day trades, do you mostly go out of the money when you're opposite direction, or you expect it when you are in the opposite direction? Is it considered a punch down, back slash down if the candle wicks out and reverses? Punch. Yes, yes. If it wicks out or price reverses below it, yes, and then reclaims the floor or reclaims the top, yeah. No, you're okay. Yes. Bounces, yes. Everything that I do. So the concept is simple to me. When I place a target, and this is going to sound cocky, but when I hit place a target on the chart, it typically gets hit. You know what I mean? And because and this is just I trust my strategy and I also trust my analysis. If you don't trust yourself, then you're going to have problems. But I trust that what I set down is going to get hit, especially in those pockets of empty space. So I typically pick the contract that's appropriate. I think the mistake that I make sometimes is sometimes I expect too much when I know damn well that, hourly candles or daily 24-hour candles, but that's typically why I leave runners. So, or I'll trim my position as it's moving there. Say the price is at 600 and it's falling. It goes to 595. Are you looking at calls at 605 to get them cheaper? Mm, that's a great question. So let's talk about that. Um, on certain, so let's talk about this, right? Because this is actually pretty important and it is discretionary in the sense where each stock is going to have a volume spread out further or closer together, right? Tesla or even excuse my language, but Alta, the contracts on Alta, if I'm not mistaken, I'm going to look right now. Um, okay, so let me read this out to you. Alta, which is at the bell, was at 624.70. So the 622 puts, 622.50 puts were $2,500 at the ask and $1,800 right at the bid. Go to my target, which was the 565 area, 567 area, right? Or the 570s. 570 is 400 ask, 300 spread, right? So a stock that carries or has a lot of or is expensive, right? So you look at something like Tesla. When Tesla moves fast, the people are trying to get into this trade and they expect it to move big. And the contract's $100. I have traded Tesla $100 out of the money for price to only move $25 and get a 900% return. So there this is why I say it's discretionary, because on the ETFs, typically it's 3 strikes beyond your target, right? So there are, yes, some, like when I hedge, right? Or I hedge a bounce. I'll hedge a bounce with something that's farther out of the money or beyond that, like, yeah, $600 is worth of boxes. And so expecting that price is going to move the same way it did down, I would look for maybe like a 602 or 603. And then when 600 gets hit, yeah, I'll take that off. So, yes, but one thing you don't want to do is compromise and start going too far out of the money where then you just have to hold on to hope. And that's, I know, a mistake that a lot of you guys probably have made already. You have to, if you can't, you don't. It's just that simple. If you can't, you don't. And it's the times that you get rewarded for doing it, right? that reinforce that bad behavior. So I say if you can't pick the target that you expect, if you can't be within at least a couple strikes of that target, then it's not for you and you need to move somewhere else. All right. Now, anybody have any questions on that? I know I'm a little late, but I have, but I'll could be covering them again. So, um, anything else on this? I think I'm reading the comments here. Okay. All right. Looks good. All right. And so now I'm going to teach you guys about the Greeks. And in rare opportunities, right? I'm not always staring at the Greeks. They're not my total focus. It's pretty simple. If I have the target based contract and the target gets hit, I'm going to make money, right? It's just you don't have to be a Greek matician, like you don't need to be. It's when you're looking at longer things that those things become more important. So, as Socrates says, this shit is complicated as fuck. All right. So let's talk about theta. All right. And this is obviously famous. Most of you guys might know what it is, but theta is the measurement of time decay. As a contract nears its expiration date, it drops more in value. If the underlying stock price drops dramatically or rises significantly, that will affect the option price as well. That's why analysts frequently use the phrase all other things being equal when discussing theta or any of the other Greeks. All other things being equal in this context means that if the stock price and implied volatility are the same, then you can expect the price of an option to drop every day as it gets closer. Socrates said that? No, he did not say that, dude. um, but sorry. Then you can expect the price of the option to drop every day that it gets closer to expiration, right? And so, yes, and this happens obviously on weekly contracts, instantly we see the decay throughout the day as it gets closer and closer to that expiration. But this is just a measurement of how much money or how much money you can expect that contract to lose in value per day that it is not in the money. Or even if it is in the money, it does have a small rate of time decay. Now, why theta matters. Calls theta or time decay works against you when you're long on an option. Let's say you're trading Facebook. I made this back when it was called Facebook, and you are selecting next month's options chain for September 31st. 265 calls and you see the theta is at 0.15, right? So why is this negative? Remember, theta is a measurement of time decay. It allows you to see how much a call option is likely to decrease in value every day. So if the theta for the 265 call is 0.15, then you can expect the contract to decrease about 15 cents or $15 per day. Now there's other variables in there like the underlying asset, but in itself. Simplified, according to Carfax, a new car loses 60% of its total value over the first 5 years of its life, 10% when it's driven out of the dealership. Theta behavior is inverse for that. For an at-the-money option, the time value of an option is stable until it gets close to expiration, when it drops more precipitous. I can never fucking say this word, and I type it. It's one of my favorite words. Precipitously. Precipitation. Precipitously. Nope, it's not going to work. Anyway, you get it. I like words that I can't pronounce, apparently. In the money options lose value more linearly. Linearly. Lord have mercy. Gamma. This is one of my favorite. I love Gamma. Gamma's my friend. And in rare occasions, Gamma has led me to make absolute redonkulous bags. Because when I'm looking at contracts coming out of consolidation that have had heavy volatility, we've traded contracts that have ridiculous gamma but low delta. But this is what I'm going to teach you. So what is gamma? Gamma tracks delta's rate of change. Delta, right, is obviously, and I don't know why I flipped those slides. Oh, I deleted the delta slide. That's why. And good job. Delta, right? Delta's rate of tracks delta's rate of change, right? Delta. So you can go look at your contracts right now, right? On, say IWM. So go pull up your brokerages and go to IWM and look at tomorrow's contract, right? And look at the, let's say, the 240 strike. That has a delta of $0.9, right? And or 0.09, and a gamma of 0.02, right? So not a lot. However, and so that you could expect for that one to change per dollar 9 cents. Now, obviously, there's other variables that can add to that or increase that. If you go to the 246 contract, right? If it will let me. Hold on a second. That, the 245 has a 0.30. I'm in puts, or looking at puts. That has a 0.30 delta. So what that means is per dollar move, you're going to be making $30 per contract. The delta, right, being at 0.06 is how per every dollar move, right, we're going to be adding that to delta. So if I have a delta of 0.30, right, gamma, I'm sorry, yeah, you got it. If I have a delta of 0.30 and a gamma of 0.05, and the stock moves from 100 to 101, the premium will increase by 30 cents. If the stock moves to 102, then the premium will increase another 35 cents because we add delta and gamma together. Now, on some of these really low priced contracts that have a lot of volatility, on something that's not moving, I have, and we have, this moment has kind of phased out. We haven't seen gamma as high, although when the ETFs break their freaking ranges, we'll see gamma return. But gamma, we have seen gamma on certain, Affirm was the one that I'm referring to, and this is going back, oh my God, dude, we used to trade the crap out of Affirm, and I made a lot of money trading this thing. Where was it? Down in here. And what the issue was with this thing is it would have these explosive price moves up and down, and then it would go flat. And it would, because the volume would leave so fast, it almost left like a shell in the Greeks where you had a gamma of 90, but a delta of 10. So you would have like this insane gamma squeeze out. Please don't look at my window, please. All right, that's 2 looks. You get one more. That's 3 looks. You're out of here. All right. I hate when my neighbors look at my window. That's why I don't leave my window open. I just made eye contact with them. So this is just an interesting Greek to keep your eyes on because you can potentially see that if there is empty space above you, a punchback. Also, this was a little punchback for you right there. Beautiful. Bam. Beautiful. But this is where you can see how much that contract is likely to accumulate. So if you're taking a low risk position, right, you can kind of factor that in. So gamma is most beneficial to long option holders as it accelerates profit for every dollar the underlying asset moves in our favor and decelerates losses for us every dollar that the underlying moves against us. Since delta is the rate of change of an option's price and gamma increases the option's delta as it moves closer to or further in the money, in the example above, the delta would just continue to increase. Every dollar the underlying increases would result in more and more efficient returns on the investor's capital. This phenomenon also decelerates losses as it works in the opposite way for every dollar the underlying moves against us. This is generally something I'm not concerned of. So when you would move on a firm, yes, you would make 100. Yes, the contracts on a dollar move, because it would just shoot out and all that volume would just come rushing back in. But yes, we not sure, there's probably not a ton of those people who were there here, but no, this was a trade. I could probably dig it up out of my YouTube or something like that. There's 800 videos in there, but yeah, we traded a firm for probably like 2 or 3 weeks straight, and it was wild. I remember the last took a trade I took on it. It was like it didn't work. Everything died. Like the gamma was extreme. I had never seen anything like it before. Um, 15 to 80 cents at open. Yeah, yeah. The price, and if it did gap up overnight, you would see some. And I'm not saying. I mean, there's probably stocks out there right now with high gamma, but again, that takes research. So I freaked out. It was my first trade. No shit, really? Okay, so yeah, you were there. Yeah, it was extreme. I had a contract. The highest return I had was a $40 contract that those contracts sold for $1,400 a piece. Yeah, he's really a historian. All right. Now Vega. This is one again. I'm not really paying attention to this one at all. But Vega is the Greek metric that allows us to see our exposure to changes in implied volatility. So it's insight into IV. Vega values represent the change in an options price given the 1% move in implied volatility. All else equal. Long options and spreads have positive Vega. Short options have negative Vega. What the hell? When thinking about Vega, we have to remember that implied volatility is a reflection of the price action in the option market. When the option prices are being bid up or bought up, people purchasing them, the implied volatility will increase. When options are being sold, the implied volatility will decrease. With that being said, when being in long options, we want the price of the option to increase. When being short options, we want the price of the option to decrease. This is why long options have positive Vega. I don't know why I typed it like that. And short options have negative Vega. An increase in implied volatility will benefit the long option holder, as that indicates an increase in option pricing, hence the positive Vega assignment. A decrease in implied volatility will benefit the short option holder, as it indicates a decrease in option pricing, hence the negative Vega assignment. All right. Now, this is all of those together. Delta, again, categorically tracks price. Delta is one of the biggest rules in options trading, especially for option buyers. Delta identifies how much the premium will change based off of a $1 move or underlying stock. So, for the example, if you buy a call with $30 delta and the stock moves from $100 to 101, your option will increase $30 in delta or in value. Delta is also used to predict the probability of an option expiring in the money. What? That's how people use it. I've never been a person to do that. However, if people see a point 30 delta, they'll say that it has a 30% chance of closing in the money. That's what they say. I've never really subscribed to that ideology at all. All right. Now, does anybody have any questions on the Greeks? They are pretty straightforward. I am not constantly surveying them. They are most important to me on long expiration contracts. That is where I need to look at them, right? I also try to situate myself on or in positions that do not have a lot of hands on them. So I'll even pick kind of an obscure strike price. But the reality is that this is not something that I'm constantly surveying. I am not stupid, right? I know in my mind I can calculate, that if I buy an option for 15 bucks for the 605 strike and we hit 605, I'm going to make money, right? And if there's empty space on the way there, perfect. Think about what you're saying. Gamma Tesla used to move up $18 a day on average. I bet you're going. Oh, dude, it was nuts. Yes, yes, Ivan. That is. Yep. Think about what you're saying. Gamma Tesla used to move up 18 on it. Yeah, so that was one of the huge things. And that's something that has died off, right? We don't see those big guys kind of making those extreme moves anymore. A lot of, like Meta, which also carried one as well. This one's had its rip. I played that one. But since, right, we've been in kind of a crazy chop zone. This kills that off. Now we start seeing think about it this way. The crazier the market gets, the farther those things spread out. The more people are attracted. And therefore, the higher the volume, the higher the delta, the higher the gamma, higher the IV, those price fluctuations matter. All right. Now, I'm going to go over some basic, again, in terms of what we're looking at. And I was tempted to skip this because it is very situational, but I want to give you guys an idea again. And at this point in time, when I was teaching this, I was teaching it based on the fact that most scalpers don't go far out of the money. They just don't. And they typically try to stick because the price movements inside of small pockets are going to be less, right? We're going to see less movement. We're going to see one big pop. And so typically those individuals want to be in something that's a little bit closer, right? And they also, again, are looking at the delta on those contracts, obviously, or IV as well, because those contracts can be overinflated and make their trading that much harder. Now, 9.9 times out of 10, if I am scalping, right, I'm going to be, and I've done this now on Tesla or on Qs and IWM. I scalped Qs when it gapped down and then popped back up. I had some runners on the downside, and so I decided to scalp my way back up to the upside. And this is where I am looking typically 1 to 3 steps out of the money. And again, scalping is not something that I do on a regular basis. It is mostly just like how day trading wasn't something I did on a regular basis. It was only meant to circumvent the swing trade results, whether good or bad, increase the profitability on them or decrease the loss on them by trading in the opposite direction. And so it just like that, oftentimes, if you see me scalping, I am actively, I see something on a lower time frame that's so clear that I know that it's going to go in the opposite direction that I want. And so I'll place a scalp, typically, I'm typically 3 strikes out. I think that's probably more of my golden rule at this point. Except for, well, those are out of the money, like based on the higher time frame. Yeah, I don't think I've seen you day trade as much as you have this week. Yeah. Yeah, this week has probably been top for this year for sure. Any contract with a theta reaching over 25% of the contract's value are high risk, right? So if I have a theta that's, digging into like it's damn near a quarter of my contract, no, you're taking and the more expensive those contracts are, the worse it gets, right? Now, IWM is one of my favorites because I can trade 2, 3 steps out of the money for $60, for $80, and I can lower my risk and still be able to accomplish my goal. Now, Delta, right? Out of the money, strikes, these are going to be favorable for me. Again, in relation to the contract that I'm trading, if I have a $700 contract, the $41 delta ain't going to do it, right? It's again it's typically something that's out of the money and has yet to increase an IV that I'm targeting. So but again, I don't scalp as much, but I think the most important thing you need to pull out of this slide is it's 1 to 3 strikes out of side of where A, you're targeting, right? Or B, where price is currently at. Now, this is an example of a disgusting options chain, right? We got high open interest. We've got delta that's low compared to the price, and we got ridiculously high theta. Now, the contracts, yes, are expensive, but that's still ridiculously high theta. That's low gamma. This is something that's so bloated that it doesn't leave room for those fluctuations. I stay away from those. Now, day trading, right? Again, and this is just focusing on the preferable data or delta that we would be focusing on. Again, I'm not always doing this all the time, but in those situations where I'm planning for a day trade and I'm looking to select a strike price, obviously you don't want to buy something with trash delta or trash gamma. All right, so Meta, right? It's got a 31 delta, 3 gamma, and 34 theta, right? So, or 0.34 theta, sorry, on that 307 strike. Where did I put that? Oh, I deleted it. Great. Yeah. Um, so typically when I'm looking to day trade, right, the favorable, and this is relatively favorable in the sense where, yeah, we do have theta at 34 cents. The contract's $281, right? You get a drop down below those red candles, a break through this range, and a drop underneath this floor, and price sinks down into this area of consolidation, which I have badly marked. That being said, typically on a day trade, I'm sticking to relatively the same rules. If I'm aiming farther out, or if I'm aiming on a day trade on something that's in relation to the higher time frame and has to break any sort of 24-hour resistance, floor, whatever. Those are the areas where I add a week or I add expiration, and it becomes almost borderline a potential swing trade at that point, depending on how price moves. But with that being said, any day trading contracts that I select, again, are going to be target based um, through empty space. However, if I'm taking something that has resistance in front of me, I'm typically going to be 3 strikes out of the money. And this is a 302 strike, has a really good theta, right? Low decay, high delta, higher delta. The cost is a little bit juicy, and obviously the implied volatility is relatively low. So, all right. Now we're going to do some exercises with this in just a second. Now, meta, again, day trading, these 3 strikes would be acceptable, right? Based on that 301 right here, we have 302, 305, 307, and 310. One thing you'll notice about this chain is it doesn't decay very rapidly, right? We lose about $80 per strike, right? Or there's $80 less in value. But because those contracts are inflated and the implied volatility is solid, as well as the delta that drops off a little bit extra right here, but these 3 strikes obviously would be preferred Greek in terms, or rather in relation to the Greeks. So now to kind of guide you through, right, a more realistic approach, because again, I'm giving you the blueprint of what works in your regular scenarios in adherence to how I trade my system, right? I'll show you guys or rather how I'm selecting contracts. Now, I took a short out today on Meta. Now, Meta, right? Let's tell the whole story here before we keep going. Meta popped out, hit a cost basis directly up above it, and then dropped back down into its box. Pushed and punched to a new low. It is a new low, right? And shot back up to go retest the high. Now, Meta is one of those ones that is guilty of not dodging the system, but bending it. And it does, because it will drop into a box and keep chopping before it breaks. But looking at this as a potential, because it's coming off of that rejection, to go for the fourth time, or fifth time, excuse me, fifth time down here on the floor. What am I going to be targeting here to my left? Right? Everybody sees this? The lack of empty space and Wait for it. Gap. Gap shares floor. Same floor that we popped off here. So naturally, if I'm looking for a break here at 632.75 and a drop down to 616, what do I have in front of me? I have a floor, correct? At a week. I have wicks that I need to drop through at a week. So you would need 2 weeks of expiration. And I base my it's a great way to get a solid blueprint of where or what contracts you need to be selecting in relation to the price, and how what's in front of you is going to determine the strike and expiration that or the expiration that you choose. If I have, right, something, listen, and this is the mistake that, some people make trying to short floors on 24-hour time frames with shorter expiration contracts, and they get absolutely faded. But knowing that I'm, again, taking this short and looking for a drop and a break of 632, which has resiliently bounced every single time. And without this breaking and closing underneath the floor, I don't have confirmation. I don't have confirmation. So therefore, if price hits this floor and bounces, I have the expiration to deal with it. I have the expiration. And when it does hit that floor, what do you think I'm going to be doing? Right? I'm going to be looking at what's above and what's below. Now, thank goodness, right, in some sense, that Meta has built a lot of structure ahead of it. So that way, if it does fall, I would have something to say, well, okay, if you look at it go up right when I start looking at it, try to scare me. But if I actually, hold on one second. There we go. That's a little bit better. So if price moves over 641.60, right, I can assume that price is likely going to move back up, and I have the time and expiration that will not beat my ass. So many of you in here have probably been watching your accounts go up and down and up and down, and you probably are trading shorter expiration contracts only. That is not my game. I do trade. That is the most exciting. That's probably why a lot of people show up, because they want the shorter expiration, day trade scalps or target based gambles. But in reality, right, when you're looking at much bigger moves, quick dopamine, right? When you're looking for much bigger moves, you need the right expiration to deal with the resistance and floors that are above you. So with Meta, right, rather than trying to or sit here and micromanage everything, I can set alerts or I can watch, right, and say, well, if you get above this, you're going to end up going up and retesting wherever, right? In order for me to capture, just like I would on a lower time frame, this move, I have to include, right, what has to break. Has Meta broken anything that guarantees me a new low? No. Expiration at a week, right, for the floor. And you have the wicks, which obviously price has been allotted to move down and then completely reverse upon at a week. Then we get the empty space. Now, where would be the appropriate place, folks, to look at a weekly contract? Where would be the what do you guys think would be the appropriate contract? How would I be able to play Meta weekly contracts on this? What do you guys think? What would I need to see on that 24-hour candle in order to see that empty space? There you go, JW. So I like that. A close in the wicks. That is probably the perfect answer. Now, yes, a close below the floor would be great. But a close inside of the wicks means that whatever volume you had sitting under here to establish control is no longer there. So if we opened or closed at 6:30, right here on this wick, and you don't see any support, and maybe you've even retested back up above you, right? That's where we would want to see price continue to the downside, and that's where we would have a much easier time getting there. Why? Because there's no resistance. So if I and let's see, 2 hour, 1 hour, still empty, right? 30-minute, oh, still empty. 15-minute gets a little hairy, but it's still pretty empty. 5-minute, wee, hold on, we're almost there. Pretty fluid price action, right? Not a whole lot of boxes, not a whole lot of chunky volume, pretty easy to fill. So yes, in order to get it started, we're going to see a break below the floor, a close at the floor. If it closes at the floor, the next day it opens up underneath it, sure, you could look at a potential, but you don't have confirmation until we break the wicks. But if we close within them, that's where you could look at a close swing into the next day. 2 seconds. All right. All right. Higher time frames take precedence in downwards moves. Yes. Assurance that floors have broken is imperative. All right. Now, let's see here. Let's do it again. All right. Now, first of all, let me test you guys really quickly. I want you guys to be quick, all right? Up or down is what I'm going to look for here, so get ready to type. Price gaps down here. What are we doing? What's the first move? Price gaps up above here. What's the first move? Down first, right? Just even if it's momentarily, it'd be down first. Retest, right? Okay. Price drops tomorrow and closes on this floor, and then gaps down and opens below it. Right here. Where are we looking? Down. Okay. Now, can I see an appropriate place to play weeklies here? Give me your honest answer. Could I tell on this time frame? Close below the floor, but right, listen, this is where I need to get specific with you guys. Look, see that wick right there? It's going to bounce, even if it's temporarily. So if you gap down here, you might fall here, bounce, retest, and fall. How's your option contracts doing? Cooked. Cooked. So what do I need to do? 4-hour time frame, right? So we open below here, first leg down, 385. So you could look at it that way. Now I'll smooth down again, right? You see that? I I didn't even need to go there. I didn't need to go anywhere. I already know. Floor, empty space, wick. Now watch what happens when I zoom in again. Holla fucking Luya. We got structure. Everything lines up. So I can relay what I see on the higher time frame down to the lower time frame. and then actually map out, right, where price can move the most fluidly. Is price going to bounce at 386? You're damn right. So what would I need to see, right? If price opens up here, I'll have a day trade down to that target. So open here, drop here. Simple. But if you keep playing with weeklies in this space and it bounces, you're fried. So in order for me to explore, again, we have the capability with this strategy, folks. I've got two hands on my microphone right now, like I'm strangling it. We've got we've got a setup, right, that shows us when price will lack resistance and keep moving. That's and there is where you want to place yourself. So for this, can I take a out of the money long gamble? No, it's a scalp. A to B. But can I, when that's lost, right here? Yep, bring that up right here. When these levels, right, are broken, and we have that, then we can look at potentially grabbing weekly. Listen, I'll be there. Trust me, I'll be doing it. If price closes anywhere in these wicks, right, or down near these floors and below that 24-hour those 24-hour candle closes, I would look into swinging far out of the money option contracts, right? This is where you are looking for weeklies, right? That is where you could be looking for weeklies, and that's it. No more. You don't get any more, right? And this holding and hoping shit stops, right? Because if you know that that's where, if you want to do this, let's look at it the other way, right? Meta pops down here, hits my target, bounces back up, right? And we get a candle close, the market's surging. Trump has taken Viagra and some that pill from Limitless, and so he's a genius now, and he's doing great, right? Everything's growing going up here, right? In this pocket, excellent day trading opportunity. Excellent, right? Because you would have even if you had a green candle straight up here, you could look at making sure that you place a stop loss here, and that would be a great place to potentially trade up. It's empty. Obviously, same way that price moved through here, fast. And what I'm trying to do here, guys, is give you the like when you're playing with these weeklies, where those opportunities really lie. And the yes, I know that sometimes like a small price move will, make, like, for example, I think looking at Tesla, right? And I can tell you this right now. I can tell you this right now that Tesla, right, will more than likely move through this relatively quickly, right? And it has two triggers that I can observe. So let's say price ends up moving like tomorrow, right? Whips down, one big red ass candle, bounces, bounces, right? Pulls itself back up, and we get a punch through here. If you see that candle, right, is already bust through this box, no problem, and is closed at 400, you could start speculating on that move up to 404, right? Shit, you could do it before then, right? If the floor gets recovered. But you have to be trying to lead that contract into empty space on the higher time frame. So give me a chart. Pick one, anyone. I don't care what it is, or I'll pick one. Too late, I picked one. Now this right here, I would tell you straight up, you got to be on a lower time frame, right? But I can tell you right now that with all this empty space underneath us, that this floor in particular is going to be pretty fucking important. I move it out into a lower time frame, and I can already see that they've, and maybe there isn't. This is what I'm trying to do, is trying to figure out if there's an opportunity for me to do this. Now, the one thing that comes with volume, folks, the one thing that comes with an announcement or anything of this nature is they know that there are people here. And this is what they've been doing. They gave them, look, bop, bop, one last pump and sideways. And I mean, that's excruciating. Excruciating. Still boxes though. That's beautiful, actually. However, right, this thing, knowing that see, I don't like this. That to me doesn't feel empty. So I would say, no, I probably won't or wouldn't take something like this. In here, oh yeah. And there, that wick has already dropped down and filled some of that empty space. Doesn't mean that it can't be refilled in the same manner, but it's not high probability. I want unmoved upon price, fresh, empty space. So this, I saw someone say Apple. So we're finding the pockets right here. Look how you dumped. So what needs to be recovered in order for you to keep going up? I would bet pretty heavily it's going to be right there at 257.60. However, right, if this was not any other day but now, that's not, that's still going to be half, and that's actually half dead slap center in the middle of that empty space. So this would actually be an appropriate small day trading setup for sure, right? You do have one set of turbulence. So if you had weekly contracts that expire tomorrow or today, you would really want to be securing a lot of profit at 257.60. My God, Stelia. All right, let's see here. So, I mean, I would even say in this space, I would be a little hesitant to grab something that expires like tomorrow, right? Maybe next week, or maybe if it was Monday or Tuesday, I would feel comfortable taking this outside of here with two targets in mind. I don't really care about that, right? And I don't expect a huge price return off of it. So I would say off of weeklies, nah, not really, right? But if we could get, Monday, Tuesday, get the end of the week contracts, then we can look at 258.60 and 259.84. Why don't I care about that? Because it's just such little price action. In relation to what I'm trying to accomplish, I don't want to be down here. You know what I mean? Like, let's look at the 24-hour. I would want to be in here, right? I would want to, I don't want anything to do with this chart, actually. Yeah. Nope. There's pockets, right? There's pockets, but they're far away. So they're not, they have nothing to do with me. This is actually why, guys, when so many people bring me their charts, I have a particular thing that I am looking for, because you know that feeling that when you catch that first 1,000% trade, and every time I look back at these trades that I take and I see how far I stretch my money and how big of a leap I take forward, and I know that this anomaly happens every time, I'll wait a week if there's nothing else out there. I'll wait 2 weeks because I can make more in that one setup with the appropriate contract strike and expiration than I could trying to try to wrestle with it like like I have the ETFs, right? And we're in a box. What do I expect? Yesterday I had to have harsh words with myself because or no, day before yesterday. Was it yesterday? I don't know. I already put it behind me. But yeah, too aggravating for a little reward. That is essentially what I'm looking at. Is it's just not enough. And it's not enough because I don't want to put risk into the market if I know that there's something better, right? That not better stock wise, but setup wise. Obviously stock wise, but like setup wise, there's something that makes sense to me. And it is rare, guys, to have anything make sense to anybody in the stock market. Most people are out here slinging shit at the wall, hoping something sticks. I'm not, and it's really actually hard to think about it because there's so many people involved with the stock market, but there's so many people who never cross the threshold of finding any sort of strategy at all. I still see people on Forex Factory, dude. Look, there's like a little chat right here. These are like serious traders and shit. I mean, especially if you're making, a chart profile on this thing. But I mean, they're just as contradictory, you know what I mean? Like, not to say that they don't have a strategy, but there are a lot of people who don't. So to know that I have something, maybe I have to wait for it. Maybe this week isn't going to be good for it at all. But what I do know is that by putting down what is still considered to be light risk, I can make way more. But that's why I have this, like, I have this big debate with myself. I still have it all the time. Should I show up every day? And the answer is like, I want to be there for people who show up. I enjoy talking with you guys. What else do I have to do, except for spend money and make Peyton mad at me? But, and various other projects. But, I want to be there to help people who paid me. You paid me. I'm going to pay you. I'm going to try to show up. But I also know that possibly me showing up gives people the wrong idea that because I'm here, there's got to be a play, or because I can navigate price action, there's got to be a play. And it's like, no, that's not the case. You know what I mean? I very often show up, and or Manny and me will have a phone call, and I've told Manny when he can get on live more, I want him to for him to have these talks with me, because when me and him come to a conclusion, I trust that, I trust my own strategy and analysis, pretty well. But together, when we both see the same thing, him with his funny numbers and me with my boxes, I, that's what it is. And when we see price open up in range after a whippy day, 2 days of price moving up and down, we already know what time it is. And so we leave. And I try to get off as soon as I can, because it's like I don't want to sit here and lead people to the idea that because I'm here, there's just got to be something. There's not. And especially when it comes to 24-hour boxes set up to go into empty space. And again, I bring up, the championship traders, the people who are best at what they do, right? That Mark Minervini dude's obviously got it figured out, but doesn't show up. He's not here every day. I think one of the competitions he won was like he showed up like 3 or 4 times. And so it's one of those things where, if you see me show up, that doesn't mean that I see something. That means I'm looking. So, um, yeah, yeah, for sure. All right. Now let's take a look at a couple of other ones, because I want to keep cooking with this example here. Now, oh my God, that's something in a lightning fat. There's not a lot of box action here, but there is a lot of this. Let's see. And I know that a couple chips have been getting love here. That's not a box. Let's zoom in. 4-hour time frame. There you are. Right? See how I didn't even wait. I don't see it, then it's got to be somewhere else. Don't get stuck. All right. The 24 hours should always be the simplest. That's my target, right? That's my high. You shouldn't have an overcomplicated 24-hour chart. I drop down here. There. Tempted to bring this down though. Right there. Yeah, I am. I'm going to bring it down. Candle closes. Wick, 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 wick. Cost basis, as per usual, is cost basising. You've got a range directly up above you. Now, I tell you what, right? A reversal on a lower time frame would likely be tradable, right? And again, it's presumptuous for me to say that this thing is going to reverse because in reality, I have a pretty clear idea of where that reversal would happen. Price is always going to tell you what it wants or where it wants it, right? Here is where price fights to get it. Here is where price fights to hold it. Price fights to hold it. Price fights to get it. Price fights to hold it, right? Same thing here. So across the board, it all started with that cost basis here, but across the board, that is the resounding level. Now I can zoom down and investigate this. And as per usual, right, there's typically going to be something there to help me navigate. I see a pre-market range. This is something, right? Why does this keep happening? You've been disconnected. I occasionally disconnect you for fun, but other than that, no, I'm just kidding. I'm not doing that at all. I would just restart it. You're also on your phone. You're on 5G. How many tabs you got open? Let me see them tabs. Let me see your search history. All right. Now, I would say, right, that something like this, again, we're looking to see whether it does, but I'm looking at the most recent price action, and I think that you could get away with a couple of pretty solid trades on MU. Now, why would I say that? Well, if MU does decide to get moving, MU moves. Now, again, shorting this thing, even in this climate, is a little risky, right? Ultimately, you're sitting one trigger away from, is that earnings? Oh, Lord have mercy. That's either 478 or 347. But anyway, with that being said, right, this one doesn't really present a ton of those weekly contracts. However, or shorter expiration. This right here is, while it's not empty, is baseless. Now, I don't get an opportunity to talk about this because usually I'm either shorting or longing them, but it doesn't have a ton of volume sitting at the floor. So I actually would expect something like this with a gap here and gap there to flush pretty quickly. So you could look at those opportunities, say, through here, right? You could look at some of those opportunities down to 347. And again, that's the top, but runners, right, could go into the gap at 340 and possibly even lower. But the setup itself, to me, appears more as something that I would look at a much longer expiration if you were looking to take a position now, which honestly, that's pretty interesting. I'm not going to lie to you. That's pretty interesting. I'm going to set some alerts on it because this is something that I would, depending on how, if we move sideways going into earnings, that's something I might even look at taking on earnings. Now let's see, bros. Now again, I'm looking for weekly shorter expiration contracts. Now that is obviously something that you could definitely explore with shorter expiration contracts to the downside to 43.55. It is juicy. It is juicy. Now, one of the things that I'll do in these scenarios is try to look for empty space up above because obviously there's a reason, right, where we're holding this floor. So how do we approach it? Pretty empty. There's definitely empty space up there. So I would definitely want to see a confirmed break. We don't have any boxes down below us. I would definitely want to see a confirmed break to the downside, which would start by losing 47.75 and obviously 47. However, if this thing does close below that floor, yeah, I would definitely look at weekly contracts targeting 44 and 43. So, I mean, but the safer way to do this would also be to look at a 36 or $35 strike if you're looking to fill up all of that empty space, and you could take that somewhere, near or even, I mean, today would have probably been a great entry as well. So, but that's a good setup. Yeah, that's a good setup. Let's look at it on the weekly. Oh, Yeah, that's got to come back down. Yeah, that's got to come back down. All right, let's see here. GTX. So I think the thing that I'm seeing here the most, right, is it's we're not just seeing these boxes into empty space everywhere. Like this is something that, oh my God, I'd rather dive headfirst into a shallow pool, man, before I trade anything like this. I see what you did there. I see what you did there. I take it all back. I'd trade this any day, actually. Here, it's got motion. Hell yeah. How do I acquire this company? I didn't see what you did there first. I do got motion, man. Sometimes I feel it clap in the past. All right. I'm sorry. Let's see here. AMD. Now that's one that definitely has an opportunity to the downside for sure. And this one represents every other stock in the market right now with this weird, multiple times off the floor. Um, but definitely something that you could be planning in the future. Now, I'll also mention that everything that's underneath you. So like right here on this 30-minute time frame, I see a little spot for shorter expiration contracts. Yeah, you would have 194.75 as a pit stop, and then you could look at probably taking the rest of that down. But when you look at this at the 24-hour, this has a very, very, very straightforward because that bounces off of the top here. Anything in here, right? Because I imagine that when we're moving that way, it's going to be really, really fast. So that is something that in the future you could be looking at. This is also something that when it rebounds, I love that. That right there is everything. Is it now? No. But God forbid this thing pops back up, right? Because that right there would be a phenomenal trade. Phenomenal. Empty space, shorter expiration contracts. First green candle to my left would be right around 230, which is psychological. And then runners would try to get up into that 237.40. Absolutely great. All right. I want to do a few more here. So what else do we have? IWM, you guys already know the deal with this one. This one has another great opportunity. This right here, a weekly city, baby. Weekly city. We're gonna fight with this little sucker right here, which we've already whipped through before, but we're still bouncing off of. But absolutely, absolutely, this thing is great for weeklies. I mean, you look at this thing to the upside, and it's like, oh my god, if you're playing shorter expiration contracts on this, you're nuts. It's filled up, and that's the one thing that I can say about this market. It is filled up every single s- every single little bit of empty space as it dives down. But this level in particular, right, being empty space, I would predict, and you could probably quote me on this, that this is when something bad happens. This happens when something bad happens. Period. End of story. Because that sort of empty space left behind is going to be narrated by a terrible headline. Period. All right. See here. And the thing is, too, folks, one of the hardest markets to trade in is a bear market, right? Especially with the way that things move. Damn. Yeah, that's something you could definitely be looking at trading weeklies on. Now you don't have your quintessential empty space here, but do have a gravitational gap. Gaps just have gravity. They just pull. Yeah. Honestly, probably should have took weeklies overnight. I think we talked about that actually. Yeah. If you did take weeklies on Lulu, I would that 155 target is pretty clear. So I'm looking at Bros 327 puts on Robinhood at 75 cents. It doesn't move much. If it breaks 47, those contracts would move. Absolutely. Great job. Coca-Cola. So I think the conclusion right, folks, that we can come to is that the majority of your strikes, the majority of your contracts on a regular basis are going to have a layer of expiration over them. Period. End of story. If you want to maintain, right, and not see these drastic up and downs in your account, you must know where, when. Did you fall really fast intraday down to a 24-hour level? You're going to bounce, right? Did you fall fast? Typically, there's going to be something to signal you back up, and that's an area you could look at shorter expiration contracts. However, like something like today, you filled that empty space up and then immediately chopped to death. Now, Coca-Cola is not something that I ever consider to trade with anything other than a larger move in mind. Now, not to say that this thing can't pay, and it does actually. You're in a space where, holy shit! Actually, hold on, 24-hour time frame, floor, and just the wick underneath you. So I'm not gonna lie to you. Even though I hate the hate this thing's guts, it actually would be not a bad setup over 78.35 with a first target of 79.25, and that's really where you have to get into risk to reward there. And then down, man, I mean, I see 75 basically on the dot right here. So I mean, this is actually something that you could consider to be, I would say downside has a better shorter expiration setup. The upside has a little bit more flack than I was expecting when I saw on the lower or the higher time frame. So I would say, maybe if you can get a hold of 78.50, you could try and take it all the way up to the gap. But that's a good setup potentially to the downside. So when you're waiting for weeklies, but it doesn't do what you're wanting to do, Theta, is your contracts. When do you bail? Is it based on the 10 or 20%? When I know a reversal is going to happen. And here's the thing. I say that and it's like, well, when is that? There is always a sign. There is always a box. There is always structure, something up above you that has to be reclaimed. And that's when I know that it's over. What the cues this morning? Look at that evil bastard going green. What was this at? Yeah, I knew I think it was it here? Yeah, well, I think it was here at 10, right around 10:30. Look, you hit a low, you build a box, and a candle closes outside of it with what up above you? Nothing, right? You punch through this box. What's in between these two? There is a retest, but virtually nothing. Again, cost basis coming in fire, right? All fucking, excuse my language, but all day. And you chop in between the floor and the ceiling and nothing, right? And the one thing that you can see here is that they kept you from accessing this, which is probably tomorrow's day trade, right? Is anything outside of 601.80, you'd be looking up towards 603.50. And I'm on the 2 minute, by the way, but I don't need to be anywhere else. I can see that right here. You get that, you get this, period. Same way you got that. Yeah, you could start planning your day trades the night before or marking out your triggers. And then when market open, wow, that is about as compressed as I've ever, not ever, but seen price on the queues in a long time. I have not seen that on NQ or the queues in a long time. Even in here, you still get more like that's almost closer to what we're seeing right now. Yeah, you can look across the board here. This does not happen very often. There's some extreme chop, but that leads to some decent movement overall. But that being said, that's going to be really interesting there. That timing is crazy. Can you in a later class stress more on what you mean when you say that the higher time frame is reflected on the lower time frame? Yes. Yes, absolutely. I can do that right now. Um, so, um, God, what was the chart that we were just looking at? Just had it up. It's a Coca-Cola. I think it was. Okay. So the higher time frames being reflected on the lower time frames is like me dropping a candle down to this close, right? And then I move to the 4 and I see that it's obvious. Look at this small range right here. So keep dropping down. It's ugly, but that's not a really accurate representation. But from what I can see here, right, you do create this range right there. And typically, the higher time frame levels, right? Coca-Cola might be a little bit of an anomaly here, but co most stocks, that those levels are going to translate down to something, right? So let me see here. So this level on the 24-hour, right? Even though again it's a little bit off, those levels are still clear as to why you rejected or why you couldn't build above 247. And obviously today, why price held that level. So, and I wish I had better examples for you right now, but I do this literally every single day where when I do top-down analysis, you're looking to directly correlate what you saw in the 24-hour, what leads you into empty space, right? Maybe rows. So me like dropping this level here, it might be off though, there. And then going to the 4-hour, I see price hit that. And seeing that, right? Now, again, not a perfect picture, but a good enough one. I see price building underneath it, right? You see a price in pre-market tap it. Price obviously punches back up. Could you split the screen, probably make your point better? Oh yeah, I guess you're right. Probably could do that. That's what I was doing earlier or the other day. So again, right? We're looking at this 24-hour floor. And this, right, which I can also use as a signal of sorts, right? This floor being lost at $47 would also be a signal that this floor on the higher time frame is likely being lost. So I'm using the 30-minute floor here in relation, right, to that higher time frame. So let's look at Tesla. Now, floor is right here. Do you see how that 30-minute time frame and that floor, as soon as I applied it, you can see it. It's interesting too because you create a range, right, basically around it. And so again, correlating this to the higher time frame, if intraday we lost the 389.37 floor, I could say we're losing a 24-hour level. Does that make sense? We did it. Everything that you can spot or that is clear, right? So let me do the top here as well, right? Do you see that? I just dropped the top. Uh, I just dropped the top at 406.65, and I'm looking overhead, right? And I can see how price holds or sits on that level. And in this case, it does also look like you built a box around it and then popped up and punched through it. So, do you still adjust those levels? Yes, right, to be more accurate if needed, but this is the whole reason that I do top-down analysis, right? Because it's not like the 5-minute is moving independently of the 24-hour. They're all in the 24-hour has the highest precedence. You're not breaking a 24-hour level intraday without a catalyst or having already bounced on it a billion times, right? Or you've already pulled all the volume off of it, or you have to gap down underneath it. So knowing where you are on the chart on the higher time frame, like again, tomorrow, when if I end up nailing this Tesla trade and it doesn't end up punching back up and squeezing up to 404.75 or a little higher, I would be looking for that to maybe happen here at 390.85, right? Because on the 30-minute, that's the end of my empty space. Is it related? Yes, because if I lose that, I get this. And if I get this, I lost that. So everything that I do is mapped out, right? From top to bottom. And I'm looking to create a clear trading plan or a clear, like, if this, then that. I expect for this to bounce, right? When it does bounce, we'll have this range that will potentially have to break through, right? Back up above us. If it does trigger this, right? I would know A, to get out of my stop loss, but I would also know. Now look, hold on. I want you to tell me where cost basis is. Look on the 24-hour. What is that? That's my first green candle to the left above me. I know that's crazy, but it literally is the first green candle to my left and would be the most logical area to retest before you go lower, right? How many wicks I mean, we usually see these big wicks will push off of something, and oftentimes it will be the bottom of those floors. So my cost basis, my cost basis, the 50% mark of that box would also be telling me that I'm potentially recovering a 24-hour floor, which is a big thing. It's hard to break 24-hour floors intraday, but it's not that hard to recover them. The market is built on buying, guys, not selling. Right. So selling happens in quicker spurts. Buying happens typically a lot of the times in continued buying, right? Happens or a little bit more. There's a lot more strength behind that because, again, the market is literally meant to buy, not to sell. So is this making sense to you guys? How the top and the bottom of analysis is tied together is in my I will super duper elaborate on this because I need to make sure that everybody is aware of what I'm talking about. And not to mention this, guys, also look, that cost basis is also simultaneously a floor that we lost. So recovering it would be a big deal. And with little to no resistance, would this be a opportune area to maybe grab weeklies? Well, let's keep doing more charts then. But lucky you, top down analysis. Now, I'm going to help guide you through this. Weekly candles open. Where did you open? Where did you close? Trend up or down and find your Potter boxes. Simple checklist, simple chart. So let's find a new one. So that new. Something that's not hot dog water. I need something off my somewhere else. Sometimes I just need to see the names. Dang it. That's got some juicy ass empty space. Holy shit. Nice retest today, too. Okay, so let's. And through top down analysis, right? Because I'm pulling this chart up, I am not guaranteeing at all that it's going to be good. I just picked it randomly. But in order for me to sign off on this being a good setup, which actually has a lot of empty space, I need to make sure, right, that I'm doing it from the top to the bottom. And that's how I find my answers. Now, it looks like this is not a box, I don't think. No, you only got one off your floor, so it's technically a range. I could pull this up. So what I'm doing first is I'm trying to find what is above and what is below, right? Now I am well aware and can see this, and that's why I'm going to move it up there. So it does kind of look like a box, actually, a really large weekly box, maybe even monthly. You wick a low, bounce back up, retest. What was this fueled by? If it was fueled by earnings, it's not surprising that it did that. That's what I thought. So that'll be one of the only things. I didn't even see that until just now. That'll be one of the only things that throws a cost basis or box out of its loop, right? I still take punchbacks, punch downs into earnings, but have had those already being in, or if they're already in play, earnings, something like earnings can throw it for a loop. So the simple conclusion here, very simple conclusion here, is that price fell to the bottom of its box and coming into earnings shot up to the top. And any sort of upside, oh man, my toes tingle, would be above those highs. Because when you get locked in a box, you have to escape to to move. And the first logical target would be here at the first green candles to my left. I'm going to drop it on the wick because I like that better. So based on the weekly, not a bad chart, right? Not in here. I don't fuck with that. No, no. Outside of here, oh yeah, for sure. All right, let's bring this down. And now that we're on the 24-hour, that's what it looks like, right? I can see cost basis right here, but I'm going to go to the 4. The 20, actually, hold on, I'm moving too fast. So we know what the weekly looks like. Now let's look at those targets on the 24-hour. We're going to adjust that down. That's going to be to 557.38 with an entry outside right now, because we don't have a box or anything of that nature, above 482.25. Again, sometimes there's just nothing else to go off of, but that's why I like boxes, because I know that that's what needs to break. All right. So from what we can tell here, that's about it, right? We know what's up above. We can see the range, right? Here. Damn, that's almost money. If I give it the wick, it is money. That's the first target, right? 24-hour time frame, candle right there. Simple, right? Blueprint is simple. We have come to a simple conclusion, I hope, that above 483.42, there's empty space up to 420, right? On the weekly, the wick and the body at 435.40. Tightening that up on the 24-hour, knowing that we're possibly going to trade shorter expiration contracts, we would more than likely be looking at a first target at 521 and at 526 for any sort of weekly contracts. All right, so next usually is, would I trade this, right? Sometimes I see always assume that cost basis is correct and I'm wrong. I always assume that I'm wrong and cost basis is right. So or the 50% mark of something is right. So in this example where I see two solid candle closes here and only one candle bounce, right? It bounces and pulls back up. If I split that in half, right? And I'm also doing it in line with that 24-hour level, but if I see that the weekly level, right, that we've established here as the target is also the 50% mark, and I draw that, but the 50% mark is off, then I'm going to assume I'm wrong, and then it's the whole thing. So it's a discretionary thing in this example. But in most examples where there's multiple points of contact, I'm not trying to ship something into fitting. It is where it is. It's the floor here, right, and the ceiling there. That's it. and it's points of contact there. Again, the wicks don't really come off the same mark. That's it. Now, for example's sake, I'm going to drop down here and I'm going to create a trading plan as if I'm nuts enough to actually try to trade this. Right now, I'm not. Okay. So, like I said, every single time I drop down or when I drop down here, I start to see structure a little bit more clearly, right? I could see at the bottom here that we had to fight to get over 406.50. That's likely a touchdown area. I also see this right here as well, which is also the floor of this box right here that we've already punched through. But more importantly, I can see that this is our guidance system, right? Our signal system. This gets you up and gets you out. Now, anybody want to guess what I'm about to do next? Since I'm looking at this wild flow in price, that was me censoring my own answer or having a stroke. What is this possibly? Right? Channel. There it is. Right? Now, this is where I kind of have to get swifty. Right? And typically I'll start looking off those highs. And as I'm moving down, watch what I do. Watch, watch. You see this? See how I'm using that structure to my advantage? You see this? Is everybody following me right now? Because this is some far out shit right here. Nobody else is teaching this. Nobody, as far as I know. Now hold on. Crispy. Now I may, and probably just did, find the control. Wide fluctuation in price inside of a weekly box. That makes sense. And in order for this to go fill up the empty space, which it more than likely will, it's going to have to build. And in order to build, you typically need to control. And that means and starts with trend. So we could be looking at something like this, right? Building. Ooh, look at the empty space right there. See, this is where I can. This is where it's not that hard to, and they say don't try to make predictions. Like, well, you know what? I know that if you fill this empty space up too fast, you're going to chop in there. Period. Right? That's still a reactionary tool, but more than likely we'd be looking at something like this. And then all of a sudden, this changes, right? Well, how does it change? These are candles. This is volume. This is price filling up. That right there allowed me to see something that doesn't exist yet for anybody else but me. It's pretty fire, actually. I love this. I love finding channels like a little channel hound dog. All right. Now, on Zen break. All right, we're locked in. So at this point, I can come to the conclusion that this is not for me. Now, I would have done that 10 times faster. Obviously, I can see the stuff, but you get better at being able to, oh, let me look at this, what looks to be a good setup, dive in, and then come to a conclusion on whether or not you want to trade it. Sure, I would love to trade this when the time arises. There's shorter expiration opportunities in these small pockets of empty space, or slightly longer expiration opportunities through that empty space. I am going to expect that this thing either A, does not adhere to this channel, or takes weeks/months to build up to the move that it needs, as it usually does. Juicy. See that? It moves, but then it stops. Can I do NVIDIA? Oh, you want to challenge me, huh? I hate it. I hate it so much. Couldn't hate anything more. The consolidation is juicy. That you can't lie about that. I was about to say my brain felt like I took two 12 milligram Zins when you said Zen break. That was a collective consciousness thing. Yeah, the 12 milligram Zins get me through the trading day. Well, I'll be damned. that channel shit was dope as fuck. That's some upper echelon craziness that I figured out a long time ago. I was like, well, if the channels repeat themselves and that you can shrink them and widen them, then what's to say that this tiny channel doesn't get expanded? And then, like, I started seeing shit and I was like, wait, hold on. I think there's something here. I use that a lot sometimes to find channels or control or chop before it even happens. Lower and higher time frame. All right. Now, because he wants to challenge the shit out of me and also get a free signal. No, I'm just kidding. We're gonna take a look at this one. Now, I know what you're doing. That's wild. Okay, that's just absolutely diabolical, but only proves the system that much more accurate, right? So obviously we have a nice little range underneath this. We're gonna pull that back down because you're ugly and you are trapped, right? So right off the bat, I would say no. You also illustrated why these things take so long to evolve. Yeah, man. Wait till you see what NVIDIA does. Thanks, Junior. Um, let's see here. So, I mean, I think I'm a little frozen here because I'm just looking at it right now, and immediately I'm like, no. But I think it is interesting that you are literally you bounced off the same level. You are going green, right? And it does appear that Price is trying or did try to break that cost basis mark. But what this does also have you as is pinned, and it would be very easy to keep Price stuck here. However, I do not at all underestimate the fact that if 175 on the weekly is broken, which by the way, again, translating this down to the lower time frame would be much different, right? So this is a weird like a weird thing, right? Where the 24 hour says 172, right? But the weekly says 174. How do I interpret that? How do I interpret that? I see a red candle close below the floor on the weekly or at the floor on the weekly, at the floor on the weekly. And I wanted to show you something. At the floor at the weekly does mean more down. Now, what you get from that obviously is going to be a challenge on something like NVIDIA. But if I got a red candle closed down, right, that's where I would look at on Friday. Sorry, specifically on Friday. Why is that not a box? Do you see the different? Is that my cat snoring? Oh my god. Do you see how all these candles stay in the range? That's a box. And these, right, are the candles that you sit on. That's range or a range on the weekly or my god, that's throw up. It's clearly not a box, right? That's not a box at all. So weekly, you're lucky to even get a range. But this is the box. This is a range. Hence why you hit the floor. Okay. So, I mean, to finish this all up, right? The reality, and I think we're all thinking the same thing, and it's like Nvidia ripped up, and this is where I go outside of the box, and Nvidia ripped up, and it had one of the most spectacular runs that a stock can ever see. I mean, by the way, I'm including that. Watch compression. Do you see that? It all lines up. Come on, bro. See, this is where channels start to literally speak to me like, Garrett, shorten the video. I hear voices. But that's heavy at the top, boy. Oh my God. Oh my God. Give me a new pair of shoes. I think we can all feel, right, the inevitability of this right? Whether it goes back up and it tests again or it goes sideways for another month and then I think we can all feel it. That being said, there are some signals and some signs, and I'm not going to go any further with this because there's no point in trying to guide you through fucking all of it. There is key levels, right, and points that need to be lost, and everything else. I mean, dude, look at the empty space up. It almost looks like they're just pending. I mean, before any big dump, you're always going to get a pop out. I mean, and this is religious, damn near. Before any good solid dumper, you're going to go higher, right? Higher, higher, higher. Well, actually, you don't dump there. Here, look, the last candle before the dump started was a big fat green one, which I still have in the back of my mind right now as the cues in IWM. Oh, I'm already on the cues. You dumbass. They have empty space. And here's what I think. I don't think. I know what I'm going to do. If price fills this pocket of empty space up because we're in this giant ass box that just keeps bouncing on the floor, which I'm still privy to, and I'm actually looking at basically the structure that we created here that I tried to short as a potential signal to get up to the 617s. This will be a time when maybe war comes to a lull. Maybe peace talks, right? Oh, everything's looking good. Price explodes, goes back up. Oh no, Trump's an idiot, or Trump is angry and he started the war again, right? But these are the scenario. I'm not trying to be political right now, but that is something that I actually see as a probability in order to squeeze out all the retail shorts before they drive this shit back down. And if it goes back up there and doesn't result in anything, you will find me in a bear costume running down the street because I will be spreading the good word of the short, the great short. So, anyway, that being said, I'll put that on a t shirt. The video's trash. All right. Now, let's do one more. Preferably has empty space. I'm going to start looking first. What about IBM? Juicy. There's a future play. See, that's right there. You could just add this to a watch list right now. Everybody should add this to your watch list and do this. Walk with me, right? There you go. No, no. When you were dreaming, I whispered this into your ear, Junior. I can't. I broke in and no, I forgot. But yeah, you did. But this is a good one, right? Got structure underneath you. You know what you need to break. Set an alert right there. Bam. Set an alert on this floor because obviously that was important. Bam. Set an alert right here. Bam. And you're good to go. Move on. Move on. Do not stare at it anymore. Is it even close to signaling? No. Is it in between two boxes? Hell yeah. So leave it alone. But when that thing goes ding, 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 I tell you what, man, there's a lot of people when they start setting alerts, they're like, holy shit, dude, I wouldn't have caught this if I hadn't done that. All right. Now, moving on, starting with the weekly, right? Let's come to some conclusions here. Now, the first thing that I see is price whips hard, right? And then price dumps hard. So what am I going to have to do here, guys? Let's see how you guys, let's see if you remember. If I'm digging in a graveyard, I'm digging up skeletons. That was a terrible example. You get what I'm saying? No, I have to use old structure. Old. Because no new structure has been formed around it. And what you'll find here is that obviously the same areas still speak. But again, I'm trying to keep this simple. So floor's there, ceiling's there. Now, the simple conclusion here is that above 259, 260, there's empty space and there's a target of 279.31 and 290. Okay? Simple. That is what your weekly should be like. Less lines, more straightforward. Why is this a good setup? And if you can't answer it, move on. Sorry. Move on. No need, right? Dropping to the 24-hour. Oh, well, that's the structure that's stopping me from getting where I need to go, right? This little wick at the top of that structure, this is attention to detail here, folks. Look at this wick. That wick tries to grab hold of a floor. So outside of that, I got clearance. I got empty space. That's my signal. What's holding me up? Well, look at that. That's the bottom of that weekly floor. What's it held up by? Juicy volume. So what are we likely going to do? Ping pong, ping pong, ping pong. Unless the market fucking dumps. Now, we've already gone down and obviously explored these areas of consolidation here. And we'll utilize those when the time comes. But everything is perfect. And that is a great setup that just needs to work it. Now, the last little thing I can do here, because I do have a wide fluctuation in price, is I could try to find my channel again. Now, I'm going to start with the basic and most obvious here, but I know that's not going to work. And it might just be dead. It's pretty interesting because I see this here and here, which tells me the overall trend is very much down. And so when we can find, again, I'm searching for it because what I'm trying to show you with these channels is that so I see in here, we got a downtrend, right? When those downtrends break, obviously we see upside. So I'm trying to find the channel up, right? And I want it obviously to be clear. This channel tells me that it's broken. I don't believe it. So I'm going to keep searching. I think I found it. I think I did. Oh, I did. You can't get away from me, little shit. There we go. Channel, right? Now look in these targets, and I'll also look for where floors could occur, right? So clearly, get rid of these boxes, throw them out. That's what we're sitting on right now. So any loss of this would result more than likely to dropping back into here. So price, right? Not able to pop, moves down. It's going to chop for a second and then possibly glide through the rest of that empty space, which is left in here, and probably looking for touchdowns somewhere in there based on the rate. Now, this is a little bit farther out, right? Again, I can't. This is just knowing I'm looking. The reason I'm saying that is I can see that when it pulls back, it's not, here we're fueled by something. So it would take, I would assume that when you drop, you're going to drop and then chop, right? Based on how you're moving now. So that being said, I'm kind of pricing in that target a little bit farther away, kind of in the same way, right? I'm doing here, about the same amount of time. So, okay. So I think leave it at that, right? Leave it at that. Now, right? I could also start setting alerts here because I just sweetened the deal. I could possibly get this thing at a lower price with a longer expiration and try my hand over here. But what if it falls? Find a floor, dork. Find a floor and use it as your stop loss. So when price hits this and recovers something, there's your stop loss. All right, take a 5-minute potty break, guys. I'll be right back. And then we'll probably do this for about 20 more minutes. I know I'm probably filling your head up. I said potty because I have kids. All right. Sorry about that. Kids want to tell me stories. All right. I give everybody a minute to digest what I just talked about. How's everybody feeling right now? Fried, confused, alone, sad? No, shit. Don't answer the last two. Yeah, man. Overwhelmed in a good way or a bad way? Okay. It's going to take a minute for this. So here's how this is going to go. All right. You're going to start, hopefully after this point, doing top down analysis, looking for the empty space. Now, you're going to circumvent some of these issues by going in the study room and comparing charts with people who have been doing this, right? They know what a box looks like. So you're going to go through the process. You're going to be using a lot of these tools, right? And this is where you're going to get better at identifying boxes, right? Knowing what it is that you're looking for. And then it's going to be, um, again, old habits or the habits that you have now take over, or when the moments where usually those bad habits take over, that's where if you've been repeating, right, or through repetition, um, exercising and using these tools, they're going to come into play. And when the first time that you use it in real time with real price, maybe even real money on the line, it doesn't even have to be that. That's when it's going to stick. Right. So you might feel like, man, there's a lot to it's, I mean, just like anybody, so why they put pilots in flight simulators. You know what I mean? So that way you don't want to throw somebody who's been reading the manual for 2 years into a helicopter. It's not going to work very well. It's going to be, again, when they're in that simulator and there's a moment of panic or they fuck up, obviously that's your simulator is your low risk, your small amount that you're willing to learn with. So, all right. Now, let's we'll keep doing this. All right. There's going to be a pretty decent amount of us actually doing real analysis here. Now, that was the weekly, right? So I feel like maybe I should go through a couple more examples because was starting doing top-down analysis here. But so just for example's sake, just for the recording, right? When I'm on the weekly, again, my chart should look like this, right? Simple overheads, simple unders, right? Where's the target above? Where's the target below? If you can identify boxes that are relevant, you do that. If they're irrelevant, you don't, right? Man, this shit's just too fire. So we're keeping it simple, right? We want to know what's above and what's below. That sure looks short to me, man. Hot dog. No, that's not the real channel. This is the real channel. Look at that. Crispy. Look at the middle. Do you see that? Crispy. That's how you know. Crispy. Points of contact, just like everything else. Now, that being said, right, again, we're finding our targets. Damn, that is a fire. There we go. Keep an eye out for this one. That actually looks pretty good. Except for it's not a punchback. It's just a break of this structure down through these floors, which that'll be tough in itself, although it'll be a third time approaching it. And then if that breaks, you would have a good structure underneath you. Anyway, so weekly time frame, that's meta. Simple, right? Even if it's, again, not my favorite chart, I would still start with that same process, especially when I'm trying to make sure that it's a play. Man, that thing can fall. I don't think I want to put that there. There it is. The top is what I have an issue with. Now, again, let me ease some of your guys' mind, all right? Because I know that you guys are trying to be perfect. And yes, attention to detail is utmost important. Okay. Is everybody confused by this? Right? Or at least trying to place a box on it? Seems kind of confusing, right? I would say so. That's fine. Find equal points of contact on one side. And then at the top, right? I'm going to look for the solid candle close, whatever that may be. Now, a lot of the times, the red candle is where I gravitate to, but if there's no points of contact that are equal, it's not really my concern. I'm just encapsulating price, right? That's it. Because we're not trading, we are trading weekly setups sometimes, but we're not, you know, uh, putting in all the work here. So again, that's where we would move down and the picture typically will clear itself up, right? Not bad. All right. So that's the weekly on MU, or weekly on Neo, right? Not an easy chart, but we're going to simplify it. Try to anyway. Complicated little shit. So we got a floor there. Clearly have a range here, right? Was equal. Not quite. So we're again simple, not overcomplicating. Your brain's going to try to be like, well, the wick and the don't worry about it, right? As you're going to confirm these things on lower time frames. Now that wick is something. I don't know exactly what it is, but I am going to mark it out just for reasons. And other than that, right, the empty space in the most recent price action leads us here. Simple, right? Just simple. This is where we would complicate things or start looking into things in greater detail. Here's that thing that I was wondering about. It's a weird little range, and look how we are behaving. Funny enough, that is a green candle in the most recent price action and the only one besides this floor, right? This is the most recent. Look what you wick off of. When I say the first green candle to your left, by God dang, darn it, I mean it. One of the most useful pieces of information I have ever figured out, period. But that's it, right? We're just marking out our ranges top to bottom. If we can find a channel, right, then we can apply it, right? Start from my lows on the weekly. And again, I can use the lower time frames to confirm as I glide it up. Pause. And it's gone. Try that one more time. The one thing I don't want to do is ever give myself confirmation bias where I'm placing shit on things that are irrelevant just so I can get a feeling that I might be right. I'm gonna be honest with you. I'm not sure I really care for that at all. Let's see about this. Now that is very true. I know that to be a fact. I would say it's probably even applicable here. You can see, look at the floor. Look at that. Oh, I love this. I love parallel channels. Seldomly used, but extremely valuable when they are in alignment. You know what? That play could really happen then. They have earnings, I think, coming up. So I would say, if anything, you might end up seeing Neo, maybe even through this conflict, run up there on earnings and then just murder block. ER was Wednesday. All right. Well, never. Oh, that's right. It did loss. That's right. So maybe it's cooked forever. We'll see. That was a pretty important level that you wicked off of, but it is above and outside of 595 that the rest of that journey could be complete. And tomorrow will also dictate whether this closes this way, right? Oh, excuse me. That went down the wrong hole. Um, but yeah, the I think earlier I predicted that there is a possible pullback tomorrow. Oh yeah, Chinese stocks. Chinese stocks are always listen. I have my weak spots, and if anybody tells you they don't have them, they're lying. My weak spot is all-time highs, all-time lows, and fucking Chinese stocks. I can't chart them the way that I usually chart everything else. Now the weekly cleans everything up, but the 24-hour, it's there, but boy, does it suck. It's not clear like typically other setups are. So there are places now. I have my ways because Chinese stocks can be extremely rewarding, extremely. And I've had $80 contracts sell for over $2,000 on Chinese stocks. When they move, boy, and it's obviously in waves. Look at the big wave and look at how trash it is in between. And then you get a big wave, and probably going to be seeing one of these probably relatively soon. But in order for me to be able to navigate these, right, I will go and I will do this. And the cool thing about this, right, is everything typically still lines up, right? And what I'm looking for is structure. And if I see that it works, right, if I see that it's relevant, watch this. Disgusting. Somebody has to stop me. That's not relevant. But I'll look for consolidation or trend on this because it's smoothing everything out. Now, I am definitely not ever placing a trade off of that. I just bounced Baba off of its third candle. What was that? Yeah, Tuesday, Monday going into Tuesday. I just bought some. I think I had like 137 calls. Or no, I had 140 calls on Baba and 144 calls, and it gapped up decently overnight, ripped up intraday up to 139, and those contracts got some of that IB love because it's typically three strikes, 3 to 4 strikes that you'll see this. Baba and Chinese stocks can bleed out a little bit further than that. So, all right. Okay. Looks like our financial institutions are going to be collapsing soon based on the chart. Oh my God. Wow. Now, without saying a word, hands up if this makes sense. What happened here or why it's happening? Does this make sense to you without me saying another word? Take your time. I don't know what a pahun down is, but I agree. I know what you're saying. I'll just mess with you. It is, right? But let's narrate it a little deeper, right? Now there's empty space up above, and no, this weekly candle hasn't closed, but here's what happened. The sand trap, the baton. Sellers pass it, buyers try to give it back, right? They try to climb their way out. They can't do it. Sellers take them for 3 weeks in a row. Price is now potentially going to close back on or below that floor. So you'd be looking at 89.91. I see candles closing here and a weekly, again, simple, right? But I do see this range is obviously important. By losing your floor, you'd be losing this top. Just, ultimately. So hold on. Look, I know people get confused. That's the breakout. That's where you broke. See the weekly candle close directly up against it? That's juicy. And that's, again, one thing that we're not seeing a lot of now, right? Because we're not in a trending market. Or if a lot of stocks are front running the dump. And it seems like the weakest stocks right? Like what was it? Lulu, maybe? Yeah, they're like front running the dump. Like they're already just I mean, this one just punched or pushed down, closed below the wicks. I expect Lulu, does have a weekly floor right here and right here, but I mean, dude, this is a vulnerable ass stock. I think Lulu might end up, because if you look at, what is it, Under Armour? Not that this is like, well, I don't know, it is actually damn near the same thing. Um, I mean, Under Armour IPO'd and just never fucking made it, So it's a long list of here, give me Macy's. That's more of a department store type shit, but they've fallen from their grace. Um, God, what am I thinking of, that one that does a bunch of hipster clothes? Um, Urban Outfitters. Yeah, they're on here. I know some of you guys are gonna be like, what? What is it? Urban? Just better off doing that. Oh, they're gonna start it. That thing is, oh, untradeable. That's probably why most of you guys have never heard of it. But even this one, three off the top. Anyway, Lulu, which also they've got a lot of negative accusations uh heading their way. I think that someone said that they were reselling leggings, old like used leggings that have been returned or something like that. So yeah, dude, absolutely gross. Used leggings. It's like selling like used sweat rags, or like those little handkerchiefs that grandpa, dude, my grandpa used to hand me his handkerchief to wipe my nose. I used to look at him and be like, nah, man, I'm a suffer. Steelio, chill out, man. I don't wear leggings, okay? They need Sydney Sweeney to. Yeah, I'd rather die too, dude. All right. So I think you guys get the picture, right? The weekly time frame is where we do the simple time frame or simple analysis. And this is where it should be clear, right? Like I'm able to tell you that if the floor is lost here on Lulu, right, the first target would be the gap. That's simple, right? Now, obviously, I can place targets beyond that if I have higher hopes of something more diabolical. That right there would be diabolical. Something just tells me they'll be back at 83, but or at minimum 100. At that point, people might think of it as a bargain. Absolutely diabolical. But anyway, simple. Absolutely simple. It's when you dive down that we get, into the more complicated. Damn. Wait, what's happened? Wait, hold on. Let me see NQ real quick. All right. 25, 24, 5. Interesting. All right. So now with the 24-hour, things are going to get a little different. Trend can be different than the weekly. So inside of a weekly uptrend, we could potentially have a 24-hour downtrend and vice versa, right? And something that's in a very large, right? Just for examples purposes, I'll just leave it like that. But something that's in a trending down, right, will also build over time frame uptrends. Oui. So it's in an overall downtrend that doesn't break or change, but can take lower time frame uptrends. So we obviously, being able to establish on the weekly whether we're in an uptrend or downtrend. Yes, the stronger moves are going to be in that direction. However, in order to avoid being a part of that wrong direction, we can find when that trend breaks. So we could say technically, right, when levels, like that one or like especially this one are broken and we've broken our uptrend, the target may go back and die, which it has been doing continuously since 2021. Or I guess if you want to start it in 2022, that's when they were doing some things. So on that lower time frame, right, we're also focused on where candles are opening and where candles are closing, right? In this example here, we're obviously pointing out that this 24-hour candle is opening outside of the range, We're in trend, right? So we also want to find, are we coming off of a floor in a lower time frame downtrend? This is honestly like at the end of the day, I can't tell you how many times I see that one of the ETFs is built trend, and all of a sudden, I'll identify like a 2 or even a 5-minute trend down, and we've just hit the bottom of it and we're skidding, and we're also colliding with a horizontal floor to make it a confluence, which confluence again is just when two sets of data align. But when those floors are hit and I see that we've fallen fast, it's those little details that let me know that maybe it's time to get out of those weekly shorts or those ODTEs. Or maybe I need to look at a trade to the upside. If it's, what is AH and RH? After hours and regular hours, I think. I don't know. I know this. Maybe I'm gonna compare the examples. Yeah, I don't know why I put those there. I think that's just telling you to. Yeah, I think I was just telling you guys to make sure that you have both, or that you have after hours on. I think I added that like the first time I did the class. Sorry, old slide. I got fresh ones. All right, so Potter boxes above and below. Right? So we're looking to identify if there's structure, if there's a target, right? These are important things to obviously identify in order to select the trade, the entry, the exit. Confluences, which is what I was just talking about overhead resistances, or, in this example, lining up potentially floors lining up with overhead downtrends or downtrends. Um, so if we can spot those, right, and we're not forcing it, it should be there. Okay. That's one thing that I learned too, is that your own mind's imagination will get a hold of you. It's those points of contact that are evidence that what you're seeing is real. So you need to be focused on those. So we're not forcing anything, right? Especially not the channels and the confluences. But when they appear and price is moving fluidly, that's when money can be made. All right. And balances. So if you do have empty space that you're moving through, make sure you identify that 50% mark. Um, and then and then ruh, I guess at the end of it. Not exactly sure. It'll come to me. All right. Now, for examples, and I feel like you guys see me do examples on this every day, right? But that would be in this case, which is, again, not something that I'm necessarily willing or wanting to trade. But that would be identifying floors up above me. A lot of the times price is going to let me know where that floor is by wicking off of it. So clearly this is a floor in a incoherent ass looking area of consolidation. However, everything fucking lines up. Everything. Funny how that works. Um, and then what's below? Clearly, this is an area that price did not want to get to. And then when it's gotten to it, it's had a hard time hanging on and you're diving down. I would identify my floors underneath me like that, right? And then obviously there's bigger areas like this, which, oh man, this is going to line up sweet. Check this out. So I see a pocket of empty space here, and I am also going to identify this as a range. Interesting. So again, we don't have to trade this. This isn't a problem. Shouldn't stress you out, right? Because we're not going to trade it. But it's a punch down 114.67, right? Or push down through that old box, the floor. So every level matters, right? When you have punched through the box, now the floor is still relevant. So we would need to lose this. So there's a lot of work to do, right? Not something that but if it shows us that that's what it's willing to do, this is shortable. That's a nice little pocket right there for something shorter expiration. Yeah, and that's empty space all the way. So empty space has been identified. And what I was going to show you here, look. So again, you were asking me how the levels translate. That's that level, right? Now it's kind of created. If I pull this down to that candle close, that's the floor. That would be your down. So look, this would be a perfect area for you could dead ass take a decent little shorter expiration trade. Sorry to use dead ass, but it's how serious I am. And this is where, hell yeah, I would be targeting a move through here. Now, for a longer expiration contract, right? Someone who is looking to short this one, down, you definitely need some time behind you. You did wick off of the right place. Finding so you would have to situate if you were, in fact, I would just tell you right now, you probably need to be like at least 3 months out. But this would be your stop loss, right? This or this, depending on where you're able to actually average in. But hell yeah, not 3 months. I'm not talking about to the empty space. I'm talking about resuming the downtrend. Remember, because that's what it's in. It's a overall downtrend. So I'm saying, like, if you're trying to short this thing back down and maybe to 104, or excuse me, below 104, and into, damn, that's a big boy right there. Maybe down all the way into here, or maybe, yeah, like I said, all the way into the lows. Yeah, that's some big boy account type. That's some market maker ass shit right there. All right. Now, so again, I'm trying to show you guys this on stuff that's, obviously clear and then not so clear. Let's see here. Lord have mercy. Okay. So we're going to focus on this most recent price action. Again, identifying what's above and what's below. That's my floor. That's my green candles. Something tells me I'm off on my overhead resistance. Something would be right. Why? I'll show you. Tap, 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 right? These candles don't fully tap it, but they obviously avoid it. This is where price keeps pulling down, and that candle close kind of seals the deal for me as far as that being an area that sellers control. Cool. All right. Now, okay. Oh, goddamn. So you literally created a box. Watch this. Oh my God. That is your signal to the upside while simultaneously breaking out of the cage. You got some. It's not. Celsius doesn't do empty space usually. In the lot since it's filled up that empty space, it's just been wicking every time it goes somewhere. It wicks the other way before it goes down. But I mean, this would be pretty fluid price to move through. So why that box is a signal to the upside? Yes, I can explain why that box is a signal to the upside. So for those of you watching this in the future, how is this box on the 4 hour a signal to the upside? This box is the overhead resistance that has been both the area that price struggled to connect and break. And when it did, when it does, price moves rapidly. And on the 24 hour, that is empty space. That is a lack of resistance. And I will try that when it does happen. Obviously, volatility on this thing in this area is whippy. I think it could probably do for one more go, at least up to 51. But this box and its cost basis, right, is in this class, right, the signal for a punchback. So price bounces, clears this empty space, hits the floor, and holds itself up and pushes up to cost basis, right, without a wick. No wick, closes right up against it. That would be technically a signal for this to punch out and make a new high, which we would target the first green candle to our left, and that would be 46, which seems to also be a level that price fought all the way across the board. Very good. That's why. Does that make sense? If that's just on a lower time frame, my signal to the upside, right, based off of what I'm teaching you now, but also simultaneously being the area that has held this down. And when it can't, price moves. Think of it like you're holding, like literally you've drawn an arrow back, right? And this is where you can release that arrow. If obviously right there, that's where that arrow can release. And that's where that tension and all that sell pressure that you just come off of, because that's a lot, right? You got to squeeze that out, work it out. Right. And by teaching you this and showing you this, you get to see, right? And you'll get to see how price interacts with itself, right? And the price that it's left behind, and how this can be the future upside or perhaps the future downside. But the 24-hour analysis is clear. Set an alarm at 4:45? No, definitely not. No, 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 no. This is how you do this. So I'm going to show you, we're going outside of the top-down analysis. I'm going to show you how I would set an alert. Here, ask me why. Here, ask me why. I'm not telling you. No, I'm just kidding. Because I I want to see when price is getting recovered, folks. Right? I could even actually do with setting an alert right here. Not to create anxiety, but to you don't want to miss it. If you set it at the trigger, what's to say that Celsius doesn't fucking bam news hits? Because that happens a lot. Or something hits, you know. Oof. Oh my God. Look at how loosey goosey all these. Oh, look at the gaps. Sweet baby rays. You know, for an illiquid piece of crap, it's pretty structural. And it respects my box. Yeah. All right. Sorry, guys. I'm not a conventional teacher. All right. I just really love this shit a lot. It's my special interest. All right. Now, good. Hopefully that answered anybody else's questions on that. That's one for the book. And then let's go ahead. I think you guys got the picture, right? So trend, candle opens, closes above, right? Where are we in trend? Obviously, we're looking for boxes, confluences, and balances, and targets, right? Which is the PBs, the Potter boxes. And now the 4 hour, right? Now, this is where trend and trend can also be applied, right? You can start, look, this is obviously flushing down. And I actually traded this one. The price kind of grinds up and then flush down, right? Pop up and then flush down. This, right, where we're grinding up, price ended up going right into here and then flushing down because that's the trend. And that's what we haven't fully established right now on the markets. And it's going to be that first waterfall down and then build back up that you're going to start being able to track bearish trend and make more accurate trades. The first drop out of it is like skydiving. So you don't know, you got to kick the person in front of you because they won't let go of the freaking support. So we're looking for trend and trend. Again, candle closes and opens, our floors, our boxes above. So everything kind of is the same, but we're also gauging price action, right? Are we grinding price up in a downtrend? Are we in an uptrend, right? Pulling back really, really quickly and then chopping, right? These are things that we're trying to look for as potential hints for continuation in that trend. Kava actually looks like it's going to punch through itself and hit 72.55. Bet you $10. Damn, that actually looks really good. Sorry, I'll explain myself. Looks like this thing is can't get up. It had a gap here. It kept hitting the gap, and then now price keeps falling back down. It looks like it closed underneath that 80.50 again. Really poopy. Oh, well, that makes a hell lot of more sense. Holy shit. Well, now I might take that. That's a good one. The bottom. So here's another little lesson that comes with price action. When the bottom of your box is just skinny little legs, think of it like if you got skinny little legs, like Junior, right? That's where price falls quicker because you can't hold yourself up. I'm just kidding. That was a I should have taken that shot, Junior. My bad. But if you have wicks at the bottom, right, that means that the bounces happened faster. All right. So, for an example, right, I'll use this since I want to brag about it. Now, we'll go ahead and start from the weekly, right? And we're going to navigate where we are. Where are we, Potter? We're up against a box. We just came out of one. Done. 24-hour. How does that interact with one another, right? Clearly, we tried to grab. Clearly, we've tried to build. Still possible. The 24-hour candle didn't lose anything. However, it did try to pop up, hit that resistance. And on the 24-hour, it is verifiably a box. Almost got me again, you little shit. Clear target at 72.77. Oh, this is the earnings candle. Yeah, I made money on that one. So 72.50 would be the most logical target to the downside. And if you can catch it at cost basis, that would be a pretty decent trade. Anything below the floor, it is probably not worth your time. All right, so that's done, right? We can slap a little trend on here just for fun. Oh, juicy. We'll talk shop about cost basis, but 66 would be a secondary target if I was feeling froggy. And now the 4-hour. All right, now here comes the question. Does Potter have the right to feel froggy? I do. Why? Because I dropped down, got more analysis. So if I decided or positioned myself to secure the majority of my profit, right, as we near the target of 72.77 and gauge how price fell there. Did we fall fast? Are we motivated by something? Is there news? Price has empty space all the way down inside of the box. Some of you guys may have had this question and forgot it. If there is empty space coming out of the box, yes, price can fall. And yes, price typically will retrace there. Now, a lot of the times, price will plummet, bounce, retest, build, and pop down again. And that'll be your second target. So you got to be really real observant, right? And a lot of the times the most straightforward play is from A to B. So that's my 4 hour, right? Now I do want to try to secure what's above, and it looks like I'm struggling. That can't be it. I do see two candle closes there, but that's a range, right? Clearly would be a range, not a box. I'm curious on what that range looks like. So I'll go to the two. Two pulls you up. Down. I think that's pretty well situated. Price also gives away juicy trend. Damn! Hold on. That was kind of magical. That was kind of magical. It all lined up. I didn't even see this channel on the lower time or the higher time frame. And it lines up pretty snazzy. So yeah, the higher probability, and this would be a great example of confluence. So there it is, right? And I went a little too far. I can't help myself. Holy hell, it is 8:28, and I could keep going here, but that leaves enough for tomorrow's class. Hopefully, I'm still hungry, bro. Might keep going here a little bit then. I don't want to overwhelm. Thanks, I'll see you tomorrow. Stelia just took that as a goodbye. Oh my God. Tired now? Okay. Yeah, maybe we'll go ahead and reel this. Yeah, they said I'm out. 4 hours straight is tough on the voice back. Yeah, you're right. All right. Well, with that being said, great class. Hopefully this was cleared some things up for you guys, and we're going to continue tomorrow. Write down your questions if you had any tonight and you didn't get them out, or if you have any questions and you just pop into your head at 4 a.m., do it. I've been in a turnaround, waking up at 4 a.m. since Sunday. All right, there you go. Make your bed, brush your teeth, do some push-ups. Can't wait to watch this back. I read that wrong. I'm a little tired. I said, watch this from the back. Say, yo. Only ate breakfast today. Feed us more knowledge. Damn. I don't have any more, dude. Do we have homework? Um, I don't think so. If you would like to um do some top-down analysis, I'll grade it. You can give me from the weekly to the 20 or to the give me the 1 hour if you're gonna do it. If you want to do it. No pressure. All right, guys. Y'all have a wonderful night. Thanks for hanging on so long. Hopefully this made up for this was basically